Good to see you. Nice to see you. We are almost finished with financing chapter. We'll move on into closing the transaction. But before that, need to check in on everybody and see how that midterm went. Did you take your midterm? Looking at faces. Okay, I see one nodding head. Others? Put your names in the chat for me real quick if you don't mind. Okay, there we go. There we go. Okay. So a little bit later tonight, we will take some questions. So get your midterm exam questions ready. Anything that was confusing that you ran across, and for that matter, any of the practice exams, if you've been taking those, which at this point, probably a good idea to start working your way through those 5 or 6 practice exams that we gave you, because now you have enough content under your belt to make use of that. But first, let's pick up from last night, do a little bit of review. We ended with math, and let's pick that up a little bit. Well, let me do it this way. Okay, let's do it this way. If the test question said something like this: lender is charging a 1% origination fee and 3 discount points. The purchase price or the sales price is $473, and the property is being financed with a loan to value ratio of 85%. How much will these cost together, if you add them all together, both of these things? Do we have enough information? We know it's a 1% origination fee. It's 3 discount points. There's a sale price, and we know what the loan amount is based on that sale price. So I'll sit quietly for a minute and let you guys work on that. Sorry, there we go. Thought I was showing that to you. There it is. If you're just joining us, we have a little review question on the screen that I'm sharing with you. So give that a look, see what you can do with that. And I'm going to change the chat real quick to just me. So when you say something in the chat, I'm the only one that'll see it. So when you're ready, give me an answer in the chat. What's our first step? We're going to need a loan amount, aren't we? So how do we get that loan amount? It's going to be that sales price times that loan to value ratio. So our loan amount is $402.50. Step 2 is your choice. In this kind of problem, when they're just asking us what are the total combined, thank you, Libby, I saw that in the chat, of the origination fee and discount points, all we need to do is add those together and take that entire, just figure 4% of the loan amount. You could do 1% separately and then 3% separately and then add them together. But in this kind of problem, you could say 1 origination fee plus 3 discount points equals 4 total percent of this loan amount. And so what is that? $16,082. We okay there? What about this one? The loan factor type math. On this one, problem will say, what is the principal and interest payment if the loan amount is $327,500 on a 5% loan for 30-year term with a loan factor of 5.71. I just made that up. I have no idea if that's the actual loan factor that goes along with this rate in this term. But on the test, they might give you a chart to look at, but I feel like they're probably just going to give you a loan factor to work with from the chart. You're not probably going to have to find it on the chart itself. So if we know the loan amount and if we know the loan factor, is that enough information to figure out what the monthly principal and interest is? I'll give you a moment to work on that. did the 5% and 30-year thing cause a problem? Is that confusing? Don't forget, in these questions, in these test questions, they will very likely give you more information than you need. So if they give you a loan factor chart where you have the rate over here and the term, and you got to look, down and over and figure out what's the loan factor, in that event, if they give you a chart to work with, then yes, you need this stuff. You need the rate and the term. But if they give you the rate and the term and also the loan factor, then you could just ignore this part. All you need is that factor number itself. Because what is this factor telling us? For every $1,000 that you borrow, your principal and interest payment is going to be $5.71. So we just need to figure out how many thousands are in this loan amount. So we take that loan amount, $327.5, divide it by 1,000, and that gives us 327.5. And then we can multiply that by our loan factor, 5.71. To find out that our monthly principal and interest payment is $1,870.03. All we're doing here is saying, okay, if there was only $1,000 we were borrowing, this would be our payment, $5.71. But there's more than 1,000 we're borrowing. How much more than 1,000 is it that we're borrowing? We're borrowing 327.5 times more than $1,000. Right? That's all that we're really accomplishing here with this little calculation by dividing by this 1,000. If we were to forget to divide by 1,000, it would be a ridiculous looking number. 327.5 times 5.71 is our monthly principal and interest payment $1,870,025? No, of course not. So what I'm saying to you by showing you this is, if you run into a huge number like that, you probably just forgot the 1,000. You could just go ahead and do that right now. And there you are. Throw that step in. Because as long as you do any portion of this bottom pair of numbers, divide by 1,000, it's still going to come out to the same thing. Heck, not to confuse you, but you could use the 327.5 and divide this number by 1,000 if you wanted to, just because of how math works, but it doesn't really make much sense to do that. But certainly if you forget this step before you multiply these together and you end up with this huge number, then divide that number by 1,000 and you're probably still okay. Sometimes knowing little things like that will help you self-correct, catch yourself. How do we figure out how much our annual interest might be? So let's take our same loan amount, 327.5 loan amount. Interest rate was 5%. If we know this information, how much are we paying per month in interest? With this information, how much is our interest per month? It's our first step here. We need a circle formula if that's your thing. We're going to put our loan amount on the bottom and our interest rate on the bottom. That gives us our annual interest paid in dollars. So what's our rate? 5% as per the problem there. Loan amount is $327,500. Multiply them together. That gives us an annual interest of $16,375. But the question was, how much is the monthly interest? So how do we turn annual interest into monthly interest? Divide it by the number of months in a year. 1364.58. That's our monthly interest. What if instead of monthly interest, it asked for daily interest? How would we get per day? By the way, for your purposes in this class, yeah, there you go. Libby brought up a good point. In this class, all months have 30 days. Don't worry about February. Don't worry about March or January having 31. We're just working with 30-day months. We're taking that little calendar complication out of the mix. So if all months have 30 days and there's 12 months in a year, the year has 360 days for our purposes. So if the year has 360 days and our annual interest is $16,375, how much is our daily interest? $45.49 per day. So depending on what we need to accomplish with our math, it's just good to be able to do per day and also per month. We needed per month last night because another thing we did with these last two, with loan factor and with annual interest, turning it into monthly interest, we needed to have those things so that we could calculate the loan balance after the first month's payment. Loan balance after the first month's payment. So, working with what we have here, what's the loan amount or the loan balance after first payment? Do we have enough information? We have a loan balance that starts out at 327. I'll zoom this in a minute. 327.5. We have a principal and interest payment that we already calculated of $18.70 and 3 cents. And we also know our first month's interest payment, which is what we just calculated, was $1364.58. So we figured out all these things just now. I snuck them up on you, right? You didn't know we were doing this big problem because we did it one by one. So when you do get this big problem, what's your loan balance after the first month's payment? Figure out the loan amount. If they don't already give it to you, they might give you the sale price and the loan to value ratio, and you might have to figure it out yourself. Figure out the monthly payment using the loan factor, and then also figure out the annual interest so that you can turn that into monthly interest. So now that we have this stuff, we're going to subtract the interest in the first month from the principal and interest in the first month. And if we subtract those things out, we're going to be left with just the principal that was paid down. How much was it paid down by? 1870.03 minus 1364.58. It was paid down by $505.45. And so then we can take our $327,500 original starting out loan balance, subtract that $505.45, and find out that our loan balance after month one payment is $326,994.55. We okay there? It really does get better the more you do it. So don't be afraid of this big thing. It's just like a 4 or 5 step problem. And most math that we do is more like a 2 or 3 step problem. There's only a couple things that are this big of a long drawn out calculation. The other is what we'll get into probably tonight in the closing math from that closing chapter. And then they could ask, they probably won't ask for 3 months, but they could ask for the loan balance after the end of the second month. And if that's the case, since this is the loan balance after the first payment, then we just need to take this one and do all the same things we did the first time through. We're going to take this $326,994.55. We need to multiply it by the interest rate, the same interest rate, the same 5%, to get annual interest based on this lower loan amount. Turn that number into a monthly interest. I'm just going to leave it in the calculator, but you could clear it out and just put it to the 73 cents instead of this, the rounded version. That gives us a $1362.48 of interest. Our principal and interest doesn't change though, does it? We still have a principal and interest payment of $1870.03. So we're going to still subtract this new one from that principal and interest payment that we have, because that's the way mortgages work. We have the same payment every month. It's just that the amount of interest versus principal is what changes. So if we subtract these things, 1870.03 minus the 1362.48 means our principal loan balance came down by $507.55. Now we just need to subtract that from the 326. Well, I'll go down here. 507.55. Subtract that from this. It just so happens to be a whole number, but 326,487. After month 2. How's that? Better the second night, I hope. Okay. Let's pick back up where we left off and talk about the secondary mortgage market. The primary mortgage market is that thing where a single borrower goes into the bank and says, I want to borrow money to buy a house. And the bank or lender making that loan to that borrower is what we're talking about. That's what's happening in the primary mortgage market. those individual loans are made one by one by one by one. And many, 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 many of them are made, thousands of them. How does someone get approved for a loan? What sorts of things are the lender looking for? Tell me in the chat. Credit score. Yeah, that's a good one. They want to know that credit score. Yeah, income. How much are you making per month? That's good. Credit score. How much are you making per month? What else? Debts. There we go. That's the bulk of the conversation in the early days. How much are you making and how much are you spending? Have you ever seen a real estate agent run an ad where they're bragging about how much they sell? And they might say something like, I'm a $4 million producer. And to the general public who may not know any better, you might be thinking, oh, they made $4 million. No, they sold $4 million of real estate, which is not bad. That's great. I'm just saying, let's be clear. But even if they sold $4 million of real estate at roughly, say, 25,000 per million of income made, so 4 of those, 4 times $80,000 of income, roughly, after you take out for this and that and the other. What if they said, I made $80,000 last year? Did you make that or did you net that? Right? Did you earn $80,000 in commission? Okay, still, great job. But how much did you spend on lead generation, on advertising, on gas, on running a business? If you made 80 in commissions but spent 75 in marketing because you put your name all over the place and have bus benches and billboards, and heck, a billboard is like $2 or $3 grand a month at least. If you spent all your money that you made, good for you for making it, but how much did you keep? That's what I'm impressed by. For a business to tell me what they had in sales is one thing, but tell me what you had after the sales. How good of a business person are you? How well do you run the business? Do you balance your income and expenses? And that's kind of what we're talking about here. That's kind of what that lender is asking that borrower. How good of a little personal business person are you for your personal life? You might have a really good Instagram, lots of cool pictures, lots of the right clothes, the right car, the right shoes, the right hairstyle, the right everything. But do you really have as much in your bank account as your pictures show that make it seem that you do? And the lender cares about that. Because can you, if times get rough and you have to pay for an emergency medical bill or heck, an emergency vet bill, you have an animal, and a quick last minute emergency $2,000 to get something out of a dog's stomach that they might have swallowed accidentally. Any kind of random catastrophe. Are you riding the line so close in your savings and your financial situation that would cause you to miss a house payment? And that's essentially why the lender's asking all these questions about your personal business when they are considering loaning you money. So that's the whole reason for that thing we did last night. Debt to income ratio. They want to make sure there's enough room in that monthly income that you can make your payment on your house, but also those recurring debts too. And it's just so tempting for a buyer to especially when they're looking at new construction and walking through those model homes that have perfectly placed furniture and decor. Some of those model homes, they spend $90,000 to decorate those things and put the perfect furniture and colors and pictures and fixtures to make it look its very best. So when somebody buys a new house and they don't have the money to put brand new furniture in there perfectly suited for that house, they just have grandma's old couch. It kind of looks like you're wearing white socks with your black dress shoes on Sunday, right? So that's what we're talking about, right? That lender wants to make sure what happens when times get rough, because we don't want to foreclose on you. We're glad we have that as a safety net, but we'd really rather not, because they like the velocity of money, which means keep having money, stay liquid so that you can loan it out and get interest on that money. Oh no, I got to take back a house now. I got to slow down, this lender's thinking, and get this house ready to put on the market and get it sold to convert it to cash so that I can go back to my business of loaning that money out to make more money in the form of interest, right? The cycle continues. So they've made 1 million loans on the primary mortgage market. Whole bunch of little onesie-twosie people buying houses, one by one by one, borrowing money to buy houses. And they've looked at their credit scores and their risk likelihood. And so using the credit scores and the income and the debt, they classify these loans into likelihood of default. Likelihood of default. How likely are they to go into foreclosure? The higher risk loans are called subprime mortgages. Higher risk to the lender, meaning more at risk of not maintaining that payment and going into foreclosure. So a subprime mortgage is less than ideal. An ideal mortgage, like a good low risk mortgage, would be somebody with a 720 or more credit score. Highest of the high, right? 720 all the way up into the 800 level is really good credit score. And a good padding between their monthly income and their monthly debt. So the lender's going to categorize the borrowers into these levels of risk. And they're going to lump them up into buckets. Think of it as buckets, like a bucket of low risk lender loans and a bucket of medium risk and a bucket of higher risk loans. So the best risk, the lowest risk ones for the lender are, you might hear the term A paper, like A credit scores, good credit scores, A paper. Those loans are batched together so that you can sell them all. They're similar, right? If you were to organize fruit, you'd probably organize by level of ripeness and size of the fruit, right? So that you don't have something not quite ripe with something just about to turn, because then the thing turns and now it gets the whole batch rotten. I'm pulling out all the analogies tonight. I don't know where that came from. But the point is, we're batching them together and selling them in big bundles, that lender is. That's the secondary mortgage market. They're selling those loans, but they've got to be similar loans of similar risk level so that it's as safe of a product to buy as possible. Similar likelihood of getting paid back without problems. They'll sell the higher risk stuff too, but they're going to lump those together so that you're buying a bunch of loans of similar risk level. Okay. When it comes to the bank loaning the borrower money, that bank borrows money too. The bank borrows money like your local Bank of America branch. It borrows money from the biggest bank in the country. It's called the Federal Reserve System. Federal Reserve System. It's in place to help control how money flows through our economic system. It's, in fact, not federal, by the way. It's just the name of it. Sort of like Federal Express is not the post office or not a federal organization. They just chose to use the word federal in their name. So the Federal Reserve System is actually private, but it controls the interest rates. How does it control the interest rates? It sets the interest rate at which the Federal Reserve System itself loans money to your bank. And then your bank puts a little bit more on that interest rate so they can make a profit and loans it to you. So if you get a mortgage for 6.5%, you can rest assured that money you're borrowing from your bank is not being borrowed from the Federal Reserve by your bank at 6.5%. It's being borrowed for less because that's basically wholesale and retail. Anybody ever done any sort of Amazon reselling or eBay back in the day where you buy a big bunch of stuff? for a lesser price because it's a whole big wholesale amount of it. And then you sell them one by one with a premium at a higher price for each one. But you have to do the work. You're earning it because you have to do the work of selling it one by one by one. So the Federal Reserve controls the interest rate. They set the rate at which they loan money to your bank, and then your bank raises that for the rate that they loan the money to you. It also sets reserve funds for the bank, for your bank. In other words, here's sort of a little bit of history. In the 20s and 30s, what was the big national catastrophe from the 30s, 1930s? What happened in the 30s? We go back to sharing with everyone. I have a feeling some of you are going to be good instructors with me tonight. Yeah. The crash, right? Wall Street crash, what Libby says. The Great Depression. Banks went out of business. Why? The market got so bad that people lost all faith in it, and everybody went to the bank and demanded their money at the same time. Everybody had deposits in the bank, and they went there to pull their money out so they could survive because things were so bad. But the bank had to tell them, I'm sorry, what money? We don't have your money. What happened? Why didn't the bank have their money? Because the bank was loaning their money out. When you went and deposited $200 at your bank in 1930, they turned around and loaned that $200 out to the next person because they figured, what are the odds that it'll ever go bad, ever go wrong? Because they could make interest on your $200. And so practically all of the money that they had in as deposits got sent back out as loans. But then when everybody wanted to come in and claim their money that they had deposited at the same time and it wasn't there, backed by anything, the Great Depression. So we learned by our experience, and the Federal Reserve said, hey, banks, don't do that to that same level. Banks can still do that to some level, but they have a certain minimum amount of reserve funds that they have to keep on hand at any given time. They can only loan so much of their deposits at any time. And the Federal Reserve is what sets that up. Hey, banks, don't you loan every dime that people have put in your bank as a deposit, even though you'd make a whole bunch more money if you could. You need to have a safety net so that things go bad, go south, and people want to come and get their money. What's the likelihood of everybody, every depositor, every fellow bank customer, whatever bank you go to, every one of you going there and demanding your money at once? Very low, very slim likelihood that's going to happen. But in the 1930s, that's what happened. But so it's really not much of a risk that the bank is going to have to give everybody their money. If anybody has ever had to cash like a really big check, sometimes the bank has to ask you to come back tomorrow because they don't have it on hand. They're in the business not of keeping money, but of moving money, because money in motion is how you make money. Money sitting is losing money. Inflation, right? Burying money in a mason jar in your backyard, obviously your money's not going to be worth the same when it comes back out because of inflation. So movement is what matters. And then the Federal Reserve System is there to help with all of these points, create a favorable economic climate so that we stay healthy. And the administration, the president, the current reigning authority administration has some to do with this. They can determine who is the chairperson of the Federal Reserve. And I think just last year, in fact, maybe 2 years ago, Joe Biden had to decide, do I want to leave the current Federal Reserve chairman, Jerome Powell, or do I want to put in a different one? And so there for a couple of weeks, everybody was wondering, well, what's going to happen? Are we going to keep the same one or are we going to get a new one? He ended up keeping the same one. So all of that kind of moves together, right or wrong. Depends on your viewpoint, but the Federal Reserve affects our economy in that way. So now that we know how money works, how we can borrow money, and how that interest rate transposes from the Federal Reserve to your bank and then from your bank to you when you borrow money to buy a house, You borrowing that money from your bank is the primary market. That origination of the mortgage loans being created or originated. In fact, that person you talk to make that loan or to apply for that home loan, they're commonly called a loan originator because they're the starting point. They're the one that takes your application, that helps you figure out what type of loan might be best for your particular situation, lending money directly to the consumer. So what kinds of groups have enough money to lend to consumers? It comes from all kinds of places. Commercial banks, they have a chunk of money that they want to earn interest on. Therefore, they will loan money to people for mortgages. Commercial banks, insurance companies. You ever wonder why you pay that big premium, why you pay that insurance every month? And you know why. You do it so that if something goes wrong, you have some help, because medical bills just can skyrocket. But what is that insurance company doing with your money? They sure aren't sticking it in a safe. They're moving it. They're letting it make them more money. You have the coverage that your insurance premiums are paying for, but the insurance company takes your premiums and invests them in other things like real estate, and they make a bunch of interest on your money that they get to keep. So they're taking your money and they're using it to make more money. So insurance companies fund mortgages too. Endowment funds, mortgage banks versus mortgage brokers. The last two lines of both these columns. Let's talk about the difference. A bank versus a broker. If you walk into, I always go to Bank of America because it comes to mind. If you walk into your bank, I know B of A has somebody oftentimes in the lobby, and they'll say, hey, what can I help you with? And you say, I just want to go talk to a teller, or I want to see about getting a car loan or a home loan. They will sit you down with the next available customer service rep who can talk to you about home loans. And they're going to talk to you about loaning their money to you, their money, the bank's money to you to buy this house. If there's a better home loan option for you at Wells Fargo, but you just happen to be talking to Bank of America, you're not going to hear about Wells Fargo's option because you're talking to Bank of America, right? Doesn't shock you for me to say that. But if you're talking to a mortgage broker instead of a mortgage banker, then you're going to hear about both, because a mortgage broker doesn't really care where the money comes from. They're going to tell you loan options from lots of different potential places. It's sort of like a real estate broker. The difference between a real estate broker and a new construction salesperson. If you come to me to help you buy a house, I just care about making sure you get into a house for the right thing that fits your budget. I don't care who the seller is. I'll help you with new construction. I'll help you with any of the houses listed in the multiple listing service. I'll even help you with a for sale by owner down the street. I can still get paid, help you with any of those things. I'm a broker. I'm pulling people together, pulling buyers and sellers together. That's what brokers do. Well, with mortgages, it's the same thing. A mortgage broker is not loyal to any one particular lender. They have deals with all the lenders, and they can connect a borrower with lots of different types of loan products. It's so weird how it works that it's not uncommon that you could go to Bank of America directly and get the quote for how much that loan will cost to you. Then you go to a mortgage broker and they shop the same loan with Bank of America and can get it for you cheaper. So another source of funds. Another place to go. Investment groups, pension funds, like a policeman's pension fund. New York, I think, has really well-paid police officers, and their pension is really good if you can stick it out and survive all the way till the end of however long that is. So pension funds, how much are they putting in every month with their paycheck into their pension, their retirement? Where are we going to invest this pension? Is one question the managers of those funds ask, and real estate is one place for them to do so. Credit unions, anybody ever worked for the state of North Carolina, you had the opportunity to join the State Employees Credit Union, SECU. It's great to join a credit union. They usually give really good deals and lower interest rates to the members. It's usually a pretty good deal. Plus, your close family can usually get an account too. Just because you're a member of this credit union, they can be too. And it's great for kids to grow up with a credit union account as their first checking account. So they also make mortgage loans. That is driving the primary mortgage market. All of these sources of income making these loans directly to consumers. Then when they're packaged up, the marketplace at which they are sold, bought and sold, is called the secondary mortgage market, where loans are bought from loan originators, like the entire organizations individually. And they are paying another organization who wants that interest over the long term. They want to have a bunch of that stuff in their portfolio, so they'll pay somebody for a whole pile of individual loans packaged together. This is this bundle I'm going to buy from you so that I can collect interest from them over the next 30 years. And if I'm selling that bundle to someone, I'm going to get that big chunk of money now because I want my profit today instead of waiting 30 years. And so then I'm going to take that big chunk and make more individual loans, funnel it back to the primary mortgage market and make individual consumer loans that we originate one by one again, all at profit, right? All kind of builds on each other. There are a couple of different kinds of markets. The secondary mortgage market, the main one, the biggest one, and the oldest one that participates in this secondary mortgage market is called Federal National Mortgage Association. You don't have to keep saying that a million times because over the years they have turned that into a colloquial feeling, informal word called Fannie Mae. If you write out Federal National Mortgage Association, FNMA, kind of looks like Fannie Mae. So when you hear Fannie Mae in the news, they're not talking about somebody's grandma, right? They're talking about the Federal National Mortgage Association. And that's this marketplace at which mortgages are bought and sold. Fannie Mae is the biggest one. Ginnie Mae is related to the government. That's another mortgage market on the secondary mortgage market. The Government National Mortgage Association, that's Ginnie Mae. And then Freddie Mac, Federal Home Loan Mortgage Corporation, that's kind of a stretch. I don't know where they got Freddie Mac from, but that's the nickname. That's sort of like the little brother of Fannie Mae. It does loans too, but for smaller things on a smaller level. Fannie Mae will buy lots of different types of loans. They'll buy conventional loans. You can purchase, buy, and sell bundles of conventional loans as well as FHA and VA loans too. Let me pause for a minute because I think it would probably make a little more sense if we knew what I meant by conventional, FHA, and VA. So let me fast forward to the categories. That's a terrible yellow. I got to change that. Conventional loans. Conventional loans are on the private level. They are not insured or guaranteed by the government, like some other loans we're going to see in a minute. Conventional loans are going to almost always be sold on the secondary market. A bank will probably always want to sell a bundle of conventional loans because they're the easiest to sell, because they're the lowest risk, right? To get a conventional loan, you have to have better credit. It's harder to qualify for a conventional loan, so they have the lowest risk. So you can command more money if you're a lender selling a batch of conventional loans to another lender on the secondary mortgage market, for instance, called Fannie Mae. So those conventional loans are lower loan-to-value ratios. Lower. What's a high loan-to-value ratio? If I said the LTV on this loan is 90%, what's that mean? It means the borrower is borrowing 90% of the sale price. So that's not a lower LTV, right? It's lower than 95%. It's lower than 100%. It's lower. It's still a little higher than 80%. An 80% loan to value ratio means that you're borrowing 80% of the sale price. And if you're borrowing 80% of the sale price, that means you're putting as a down payment 20%, right? Because the two have to add up to the full sale price. The 80% you're borrowing plus the 20% that you have available as a down payment that you're going to put down at closing. So less risk to the lender means that lender can charge more of a profit when they sell that batch of conventional loans to another entity. If it's a conforming loan, it means it conforms to certain guidelines that have been set. So conventional loans that are conforming have to meet certain guidelines, like certain credit scores, certain qualifying ratios, and levels of risk, things that indicate how much risk they're going to be. There's also non-conforming loans. Typically, when you see the word non-conforming loan, it's talking about a bigger loan. Have you ever wondered what people do when they buy $1 million house or a $2 million house? That's a special kind of loan because you're borrowing a whole lot more money, and it's a non-conforming loan. When you want to buy $1 million plus house, the loan amount to do one of those transactions may be $700,000, $800,000, $900,000 that you're borrowing, putting down maybe $100,000, $200,000, $300,000 or $400,000 of your own money. That's called a jumbo loan because it's extra big, right? You're borrowing more than typical. And because it's so unusually large, it's called a non-conforming loan. Doesn't conform to those same guidelines. Doesn't have to. Obviously, they're going to need to have pretty good credit score to borrow more money because there's a lot of risk there. But that's all possible under a conventional loan. Make some room on my little board here. Here we go. So, with a conventional loan, we're good. If you were to pay cash for that house, let's say that the house is $500,000. Oh boy, sorry. Sale price of $500,000. Let's say this represents the entire sale price from 0 up to 5, and the entire sale price is this full graph here, top to bottom. So if you're going to buy this house for cash, you've got to bring $500,000 in cash, right? You're not borrowing anything. That's what you're expected to bring to closing. But if you're going to borrow money, and let's say you're going to put 10% as a down payment, that's this part. You're putting 10% down, and then you're going to borrow the remaining 90% of this $500,000 total. So that is your LTV, 90%. Your down payment is 10. And when you add those two things up, that comes up with 100% representing the entire sale price. So why does that matter? If the lender could pick, the lender's ideal choice would be for you to put down 20% as a down payment. The lenders have decided If someone has 20% of their own money in the purchase, they are much less likely to default on their loan. So if you put a 20% down payment, the lender's going to loan you the remaining 80%, and they're pretty happy with that deal. They feel pretty confident that you're not going to, no matter how tough life gets, you're probably not going to walk away from your 20% equity that you started with by putting 20% of your money into this thing. Let's see, 500,000, 20% of that. If you put $100,000 of your own money into the purchase of this thing, yeah, you're probably not going to, it's going to take a lot for you to just to give up on that and let this house go into foreclosure. You might even sell the Mercedes so that you can keep making the house payment and not jeopardize losing $100,000 because the house went into foreclosure. You follow me? Okay. Well, what if instead of 20% down, you only put 5% down? Just this little bit. Now the LTV is going to be 95%. That's how much you're borrowing. That's all this stuff. Do you think the lender's more worried about it than they were when you put 20% down? Yeah. So worried about it that they actually say, well, okay, fine. If you're only going to put 5% down and we really want you to put 20% down, then we're worried about this little bit of chunk right here, that lender says. We're worried about this amount, and this needs to be protected. We want you to have actually 20% down. You're only going to put 5% down. So the lender is going to require you to get an insurance policy to protect this amount of money in case you default on the loan. And it's called private mortgage insurance. Anybody heard of PMI? Private mortgage insurance is what the lender will charge you if you put less than 20% down on the house when you're borrowing a conventional loan. That PMI represents this little bit because they are worried about it since you have less than 20% down. In fact, on $500,000, you got $25,000 of your own money in the game. Skin in the game. And that's a lot to me. I'm not going to walk away from that too easily, but I would walk away from that easier than I would 100,000. So this PMI thing that you might have heard about is so that if the borrower defaults on the loan, stops paying the mortgage, the lender can foreclose on the house, but this PMI insurance policy, because that stands for private mortgage insurance, also protects the lender. The lender's going to be able to get that protection, that payout from the mortgage insurance as part of their remedy for the fact that they had to foreclose on this house. So between getting the house back in foreclosure and also getting the payout from that mortgage insurance policy, that lender feels more confident about loaning the money to a borrower who's only putting 5% down. Does that make sense? So that's this thing, that is this, which we will talk about when I see you in 10 minutes. I'll see you after break.
Hey, excuse me, bro. Hey, yo, by chance, wanna try this muscle?
Come on back and join me. Let's pick this back up. We were talking about private mortgage insurance when we left. And again, that protects the lender. If it protects the lender, who do you think pays for it? It costs something. You got to pay for this private mortgage insurance policy when you get a mortgage. Who gets to pay for this? Who's paying for this at closing for a private mortgage insurance? And then every month. Come on. Join in. Got one? Go ahead. Some more of you. Give me some answers. Don't forget this class is about participation. And while I'm talking about that, about this point, somewhere in between now and the next couple of weeks, I have to check the minutes spent in class. Zoom does that for me. I run a report. It shows me how many minutes people were tuned in actually in the Zoom classroom. So if we're getting anywhere close for some of you, I'll give you a heads up so that you'll know how close you are and how much time you have that you could possibly miss between now and the end. Because if you don't spend a certain minimum of time in the class as reported by Zoom, then you won't be able to take the final exam. So I want to make sure people don't run into that problem there toward the end. So yeah, the borrower, right? Any sort of loan fees are paid by the borrower because you're asking to borrow this money. So the lender says, look, this mortgage insurance policy benefits us. It benefits the lender, but the borrower pays for it because the lender's letting that borrower borrow money even though they're not putting a full 20% down payment. If the borrower did put 20% down, then do they have to pay for private mortgage insurance? Does there need to be a private mortgage insurance policy if there's at least 20% as a down payment? No. No PMI required. It's only required if there's less than 20% down payment. Another way to say that is the PMI is only required if there is greater than an 80% loan to value ratio. Higher than 80% would mean less down payment, right? Because an 80% LTV means you're putting 20% down. A 90% LTV means you're only putting 10% down. The other thing about this private mortgage insurance is, and the loan process in general, how does the lender feel confident that the house is actually worth the sale price? Tell me in the chat. I'll make it private. Now it's just me that will see answers. Everybody give me an answer. How does the lender feel confident that the house is not being overpaid for? Get some more answers from a couple more people. Yeah, there we go. The house has to be appraised. That's part of the loan process. The lender requires that an appraisal is done on the house. And so what if it turns out that the appraisal comes in less than the sale price? Here's what that could look like. Our sales price is $500,000. That's right here. The appraised value that the appraiser comes up with when they go out, what does that look like? An appraiser is a specialized part of the real estate industry, right? All they do is figure out what things are worth. They don't have to market properties. They don't show buyers around. They don't list properties for sale. The only thing an appraiser does is go visit the property, measure it to make sure the square footage is accurate, take some pictures probably so that they can put them in the appraisal report that they have to prepare, and then go back to the office and see what similar houses have sold for, and then compare the subject property, the one in question that's being bought and sold, to each of those comparable properties that have sold recently. And they make adjustments for the differences. If there's differences in square feet, they'll make an adjustment, a dollar adjustment. So if one of those comparables down the street sold last week for $520,000, but it had brick, and the subject property that's being appraised only had hardy plank, which is like a cement composite, kind of a wood-looking sort of siding. How much was that difference worth between brick and siding? That's part of why the $25,000, it costs $25,000 more, right? Because brick is worth more than siding. So the appraiser is going to give a dollar amount to make up for that. So that one down the street that sold for $525, if it did not have brick, but it indeed had siding like the subject does, it would have sold for less than $525. But how much less? So the appraiser just goes down the list and makes a bunch of adjustments for things like square footage, exterior siding, kitchen and bath levels of upgrades, because those are pretty important rooms. Garages, maybe a 2 versus a 3 car garage. A couple other things we'll learn about when we get to the valuation chapter. They would never compare a foreclosure property to a normal property. Like if they had a comparable that sold last week that was sold in foreclosure, that's not going to be a good comparable to use to help figure out what a regular sale property is worth. That's called, it just needs to be a similar type of sale. So that's what the appraiser's doing. So after that appraiser goes out and visits and does their homework, the only thing they can find to justify the value of this house, they have a couple of comps to use, and the best they can do is they feel like the house is worth $485,000. The appraisal comes in at $485. Right here. Sale price was up here, appraisal's down here. How much is that lender going to loan on? Are they going to base their loan on 500? Because let's just say it's going to be an 80% LTV. Are they going to loan you 80% of 500 or 80% of 485? The lower of the two. That lender is going to loan on the lower of the two. Hopefully the appraisal comes in at sale price, and many times it does. But if they can't find enough comparable sales to compare it to justify 500, the best they can come up with is a value of 485, then that's what the loan will be based on. Well, what's the difference? If we have to put 20% down payment on $500,000, how much money is that? $100,000. but that lender is only going to loan you on 485. So you're going to have a lower down payment. You're only going to need to put $97,000 down, but the seller still wants their $500. That's the problem. Is the seller willing to take less than the original agreed upon sale price? You're all set up to borrow money to buy a $500,000 house. What's the loan amount on 500? What's 80% of 500? You need to be able to borrow $400,000. But you can't. The most the lender will loan you is 80% of this appraised value. They're not going to loan you 400. They're only going to be willing to loan you 388. So what can you do? You could ask the seller, please seller, would you let us lower the sale price down to the 485? Or maybe that borrower has some extra money, cash on hand, and the seller says, you know what, if you want to buy this house, you've got to pay me my 500. I don't care that it appraised for 485 and that's what your loan's going to be based on. I want my 500. And so if that borrower can afford it, they'll need to come up with $15,000 in addition to their already planned down payment so that the seller gets their 500, the lender loans them based on the 485, and they can buy the house. So can they put an additional $15,000 down so the seller's happy? If the seller insists on this, which by the way, they do quite often right now because we're in a seller's market. The third option would be the seller says, well, I won't come all the way down to 485, but I'll come down to 495. In which case, then the borrower only needs to add another $10,000 to their down payment to get up to that 495 to keep the seller happy. And then again, borrowing based on the loan amount, based on the appraised value of 485. So that appraisal stuff can really throw a transaction into a problem. And so the loan to value ratio is going to be based on whichever's lower, sale price or appraised value. PMI is for things where the borrower is putting less than 20% down, and it's also temporary. It doesn't last the entire 30 years of the loan, or 15 or 20, however long the loan is. That's the good news. When it's a conventional loan, this PMI, paying this extra money, and by the way, it might be an extra $100 a month, maybe $200 a month, depends on the size of the amount borrowed. But let's just say it's another $100 a month. You're already paying principal, interest, taxes, and insurance. Now you also have to pay PMI on top of that, another $100 plus that. But the minute you get to the point of having 20% equity in the property, because you started maybe you put 5% down, so you were short by 15% from the 20% the lender prefers, right? You only put 5% down. Lender wanted you to put 20% down, but they let you just do 5%. But when you get to the point of having enough of your money, your skin in the game that equates to 20% equity, they won't charge you that private mortgage insurance anymore. You can cancel the policy. So it's temporary. You won't have to pay that the entire 30 years. You might only have to pay it 5 or 10 years, because by then, how do properties appreciate? That's how your equity goes up over time, through appreciation. So we've got $500,000 original purchase price. You put 5% down. So you had 5% equity when you first bought it, because that's 5% of your own money. You need to get to this 20% mark so that the PMI can be canceled. So how do we get from that 5% to the 20%? How can the property could increase in value that would give so that when you sold the property, how much money do you walk away with? That's your equity. You're going to walk away with at least your 5% that you put in down originally, unless the property depreciates. But if it does normal appreciation, over time, maybe 5 years later, that property is worth $510,000 or $515,000. So let's say it's worth $515,000 and you sell it in 5 years and you pay off the loan. You borrowed 5%. Sorry, you borrowed 95%. Your loan went down over time. Maybe it went from originally your loan amount was $475. That's what you borrowed to buy this thing. You paid that down. Let's say you got it down to $465. 5 years later, it has appreciated in value to $515. You've paid your mortgage down to $465. So now what would you walk away with if you sold it 5 years later? $50,000. $50,000 is the equity that you have in the property. Now, yeah, you might have to pay some real estate commission and some other expenses out of that, but that's essentially the equity you have in the property that you stand to lose. If it's worth $515 now, instead of selling it, you don't sell it. You just get an appraisal, or you get a real estate broker to tell you how much it's worth today, 5 years later after you buy it. Your loan balance is down because you've been making your payments. The property is appreciated. Now, what is 20% of $515? $103,000. Once you get up to that $103,000 mark of equity, then you can cancel the private mortgage insurance. So maybe another 5 years. If it's $103,000 today, 5 years after you bought it, maybe in another 5 years or so, it's worth like, say, $550. And then by then your loan balance has come down to, let's say, $440. Now what's it look like? $550 minus $440. Now you have $110,000 of equity in the property. Is that enough? Let's see. Yeah, pretty darn close. You probably have a good case to make with your lender. Hey, lender, I think I've reached 20% equity in this property. Therefore, would you please not keep charging me private mortgage insurance? And that lender will say, prove it. Pay for an appraisal. We'll have it appraised. Make sure it's really worth $550 as you think it is. Compare that to your loan amount. See what your equity is. And if it's 20% or more equity, then yes, you are done paying private mortgage insurance. So it's not forever. It's temporary. It's removed when you get to the 80% loan to value ratio that the lender prefers. We good there? That's conventional loan. It's about all you need to know about a conventional loan. Remember, it was private. It was also for the better credit borrowers, and it requires a little more down payment. You can get a conventional loan for 5%, 10, 15, 20 or more, obviously. There are some products even less than 5 available, but you'd have to have the right credit score to get it. But if you're a borrower who maybe has a lower credit score or less money available for down payment, then a conventional loan might not be for you. Maybe you need to consider a Federal Housing Administration loan, an FHA loan. The government's involved with this one because the government would rather people own homes. They want to help people own homes who ordinarily couldn't. So they will give incentives and help people by insuring the loans. An FHA loan, this is a testable item. Write this in your notebook. FHA loans are insured by the federal government. They're insured. The word insured is the key word here. When you think FHA loan, think insured by the federal government. Not guaranteed, but just insured. How are they insured? Through a version of mortgage insurance. A certain version of it. It kind of works the same way as the PMI did, except when it's an FHA loan, it's called MIP, Mortgage Insurance Premium. And through this process, that FHA loan is insured by the federal government. it makes the lenders feel more comfortable buying and selling FHA loans. Makes them more comfortable buying and selling them on that Fannie Mae secondary mortgage market in those big chunks, right? The FHA is involved because they insure the loan, but they don't originate the loan. They'll just stand behind it once the loan is made. Who makes the loan? Who originates the loan? The same lenders as do conventional mortgages. Same lenders. You could talk to the same lender and say, I want to see if I qualify for a conventional loan, and if I don't, let's see if I qualify for an FHA loan. And probably the same lenders can help you figure out both and make those either one of those loans. They can originate either one. The lenders will be the ones who originate them, not FHA. FHA's role, Federal Housing Administration's role in this, is to insure the loans once they have been made. Lenders still originate the loans. Lenders also decide on the rate that you have to repay it. And lenders are the ones who put you through the approval process and ultimately approve or deny the borrower. And just like a conventional loan, if you put less than 20% down payment, FHA is going to, the FHA loans, just like a conventional loan, is going to require that you have a mortgage insurance on it involved. But the mortgage insurance is called MIP, not PMI. So, what are the benefits of an FHA loan? The positives are they allow for you to have a lower down payment. You could put as little as 3.5% down. Typically, conventional loans, you have to put at least 5% down. FHA will let you put as little as 3.5% down. It also allows for a lower credit score. To get an FHA loan, your score can be lower. And then it also allows for your debt to income ratios to be higher. Remember the conventional ratios? Do you remember what those were from last night? What were those ratios we were working with? The front end ratio and the back end ratio. The front end was all about the PITI. No more than what percent? There it is. 28%. No more than 28% of your monthly income can go toward your house payment. And then no more than 36% of your monthly income can go toward your house payment plus your recurring debts. Well, those ratios are higher for FHA. I think they're like 36 or maybe 33, 43, something like that. You don't need to know that for this class. And in real life, you would ask the lender what those ratios are because it depends on the loan product. But so that little old lady I think I mentioned last night, she went FHA because they allowed for a 43%. And she needed that because of the cost of the house she wanted to buy and her car payment because she had a new car from the year before. Also with FHA loans, the lender is not allowed to charge you a prepayment penalty. Remember that when we referenced that last night and last week? We talked about possibly one of those provisions of a promissory note and a deed of trust would be a prepayment penalty, but that's not allowed for this kind of loan. FHA loans and VA loans that we're going to talk about next don't allow a prepayment penalty. What does that mean? If the borrower wants to pay off the loan early, the lender can't charge them a penalty for doing so. Because by paying the loan off early, that lender's not going to get all those interest payments anymore. So they might try to charge a penalty to make up for that. They're not allowed to on FHA loans. The negative for FHA loan is a kind of a big one. Remember how on a conventional loan, the mortgage insurance could go away if you got up to 20% equity? It never goes away for an FHA loan. That's a big one. Write that one down. The MIP never falls off. It's not temporary. It's going to last the whole time you have this loan. So what if the only way you can buy the house is to get an FHA loan because you don't qualify for conventional? Should you not buy it because that MIP never goes away? You should probably still just buy it because there's a lot of other advantages to owning a house. And then how can you get out from the MIP? Well, you can't while it's an FHA loan, but you could refinance into a conventional loan. The reason you did FHA was because your credit score wasn't great and you only had so much money for down payment. But once you buy the house, your house is going to appreciate. You're going to build your equity over time through appreciation plus paying down the mortgage, plus anything you might do to the house to improve it, like upgrade the kitchen. So all of those things increase your equity. And then maybe you work on your credit score and you get it up into the 720 plus range. And then maybe after 2, 3, 4, 5 years, you refinance into a conventional mortgage. Now you can, if you don't have enough equity right off the bat to not have to do PMI, at least you could work your way toward that. And probably not very long. As we saw, I just made up those numbers a while ago, but between 5 and 10 years, you probably are going to have built up enough equity to get rid of that PMI. So let's start out with FHA because that's all your choices are. And this is you talking to your potential buyer, by the way. But then you refinance into a conventional loan later. So what do we learn about FHA loans? The PMI, or it's called MIP, never goes away. It allows for lower down payment, lower credit score, and it's insured by the government. Insured. And then finally, the big 3 loan types is a VA loan. The VA loans are guaranteed by the government, not insured. The government agency involved in a VA loan is the Department of Veterans Affairs, the DVA, right? So a VA loan means a Veteran Affairs loan. It means loans made to military veterans and their spouses. So just like FHA loans, VA is not who is originating the loan, but the lender makes the loan. The lender sets the rate. The lender approves the borrower. The VA is guaranteing the loan. Now, there is a slight exception. With VA loans, think about the purpose of a VA loan. It's to help people who have served our country, right? Let's help them out. So if that veteran wants to buy in more of a country area, more rural, sometimes lenders don't make loans if it's a really, really rural kind of area, like super country, super backwoods. The VA loans in that event, if they can't find a lender to make the loan, the VA will originate a loan for that veteran. FHA won't, but a VA type of loan might if no lenders are available and willing to do so. What are the positives of a VA loan? Remember how a conventional could be as low as 5% down? FHA can be as low as 3.5% down. Well, a VA loan can be as low as no money down. That's the big positive that gets a lot of veterans interested in this kind of loan. They don't have to make a down payment. They are also allowed to prepay the loan without a penalty. Just like FHA loans, you can't charge a prepayment penalty. Lenders can't charge that. And then here's something a little different. VA loans are assumable by another buyer. If a veteran owns a house that they bought using a VA loan, they could sell that house to another buyer. Doesn't have to be a veteran. And that buyer, if they qualify, they could assume that VA loan from the veteran. So if the test question said, are all VA loans held by veterans? The answer would be no, because it could be a spouse of a veteran. It could also be just a complete non-veteran person who happened to buy the house and assume the VA loan that was on the house already. They would have to qualify for it, but they could assume that. Here's the problem with letting someone assume your VA loan. You only have a certain amount of entitlement available to you as a veteran to get a VA loan. So while that person has assumed your VA loan, you're out that amount of your entitlement. You can't go get another VA loan if they've used up the entire amount that you're entitled to borrow with this VA loan. So as long as you don't want to go get another VA loan, sure, let somebody assume yours. But if you let somebody assume yours, you're going to have to wait until they get rid of it, like refinance into a FHA or conventional, something like that, to free up your VA loan eligibility. Now you've got your eligibility back to go and get another VA loan. There are some fees paid at closing called funding fees. That's a negative. There's also an origination fee charged at closing. And then you can only have one VA loan at a time. So let's think about it. The conventional loan, the FHA loan, and the VA type loan, all three, which one allows for which one requires the best credit score? Good job. That conventional loan requires the best credit score. Which one requires the most down payment typically? The highest down payment. Conventional again. Yeah. Which one allows for the lowest down payment? A VA allows for as low as 0 down payment. Good job. And which one of the three is insured by the federal government? You got it. Great job. The FHA loans are insured by the federal government. Sorry, guys. I'm checking into something I might try to do. But no, I'm not going to do that. Okay. You can still hear me okay? Okay, good. Which one is assumable as long as the Veterans Administration approves it? Kind of gave it away, right? So with that in mind, a couple other things about a VA loan. The appraisal is not called an appraisal. It's called a certificate of reasonable value. When that appraisal is done, they issue a certificate of reasonable value. It's still an appraisal, but the thing that kind of declares how much that property is worth is called the CRV. They have to use for both FHA and VA loans, they have to have appraisers that are specially trained, that are approved. It has to be a VA appraiser or an FHA appraiser. That's a normal appraiser who has gone through extra training to know what the VA and FHA cares about. And a couple of the things that they care about are making sure the property is in particularly good shape. Someone using a conventional loan can buy a fixer-upper property that needs a new roof, that has some broken windows, that doesn't even have a range or oven, that maybe has some big holes in the wall, the sheetrock, but you'll never get an FHA appraiser to sign off on a house in that condition to make an FHA loan. FHA and VA appraisers are looking for big problems like that because, again, why are they in existence? FHA loans are there to help people who normally wouldn't be able to get a house, and VA are as well. So why would we let someone get a loan only to set them up for failure because next year it's going to need a new roof? So to get an FHA or VA loan, the roof needs to be in pretty good shape. It can't only have a year or two life left in it. And so the seller, because the borrower probably can't afford to put a new roof on it, so the seller would have to put a new roof on it if the VA appraiser failed the appraisal. But does the seller have to put a new roof on it? Only if they want to sell to this buyer. They don't have to. They could say, well, I'm not interested in doing that. Buyer can just walk away. What if the buyer walks away because the seller won't put the new roof on that the appraiser requires? Does that buyer lose the due diligence money? Yes, they do. That due diligence money is gone. So if you're a buyer agent helping people using FHA loan money or VA, make sure that you pick good houses for them to look at. Don't show them houses that are going to have problems with the appraisal. And other items that are going to be a problem on the appraisal are broken windows. Must have a working range oven. And can't have significant damage. Because again, we don't want that new buyer borrower, to have to spend a bunch of money on this thing. Now that you know the basic three types of loans, now let's look at this again. That primary mortgage market. They are, there we go, purchasing all three kinds. They're purchasing all three: conventional loans in big packages, FHA loans in big packages, and VA loans. It's the oldest and largest of the participants to the secondary mortgage market. Fannie Mae, Ginnie Mae, Freddie Mac. Fannie Mae is the biggest one. It's the oldest one too. It also helps make policy, because the people involved running Fannie Mae help the government create housing policies. For basically, it all goes back to sanitary conditions, healthy conditions, not unsafe, right? Safe conditions. It also establishes that market, that secondary market for buying and selling loans, big chunks of loans. Fannie Mae could also manage and resell loans if needed to help stabilize the mortgage market. And what they also do is decide what these guidelines are in allowing people to borrow money. They establish underwriting guidelines. That means the hoops you have to jump through to get a loan are due in part to what Fannie Mae says. Fannie Mae helps decide what you have to have in order to qualify for a loan. When they look at your pay stubs, when they look at your bank statements and your tax returns, your credit scores, all of those minimums and categories and all of those things that you're having to jump through and prove is due in part to what Fannie Mae and the lenders decide is the best way to ensure somebody's going to pay their mortgage on time. It all comes back to what's the greatest likelihood these people will not default on their loans. And the best way to predict if a borrower will default or not is to require certain things of them. And those things are called underwriting guidelines. The steps involved, by the way, in getting a loan. Remember, the first person you talk to is the originator. That's the LO, the loan originator. They're going to collect some information from you, those things we talked about. They're going to pass them on up the chain. And once you apply for the loan, they're going to hand them off to another person within the organization that works for the lender. And they're called the loan processor. That processor you never meet. You might get an email from them because they might say, you know what, it's been another month since you started the application. I need a new pay stub. The loan originator may not want to be bothered by this. They might need to be out getting more new loans. So you might be dealing with an email from that processor helping round up some additional information if needed. Once the processor does all of the stuff they do, they just go down and look through the computer screen, checking boxes. Do we have the most recent of all these things? Do we have everything we need? The job of the processor is to make this loan package as attractive and thorough as possible for the underwriter to make the final decision about whether the loan will be allowed. And so once that processor has done all of that stuff that she's doing, she'll pass this thing off as an entire package of information to the loan underwriter, and that's the person with the final say-so. And that's what this means by underwriting guidelines. The guidelines that underwriter's looking at determine whether or not that underwriter will allow this loan to go through. So that's who you're ultimately hoping to get final approval from, the underwriter. So Fannie Mae helps establish what those guidelines are. Fannie Mae deals in all three of these types of loans, conventional, FHA, and VA. However, conventional are the least amount of risk. We talked about that. Fannie Mae would probably rather not interact with FHA and VA loans. And if they were just dealing with them of their own, just a bunch of FHA, VA loans just out there in the market, they wouldn't work with them. They would not buy and sell and allow the buying and selling of FHA and VA loans in their market, in this Fannie Mae marketplace. They would not do it. The only way that they allow FHA and VA loans to be bought and sold is because this organization, the government version, stands behind those loans and will take the risk away. They'll pay the risk differential for these FHA and VA loans. They work with Fannie Mae on these higher risk loans, and Fannie Mae feels more at peace and is like, okay, well, if things go south with these loans, at least the government will step in and help us be made whole again. So therefore, sure, okay, we will also buy and sell chunks of FHA and VA loans too. It's because the government is involved with those and they'll stand behind them in the form of Ginnie Mae, the Government National Mortgage Association. It allows investors to purchase shares in big pools of loans as well. You can buy shares in real estate loan holdings. And Ginnie Mae pays directly out to the investors as well. So it's essentially a government agency under housing and urban development. If it weren't for Ginnie Mae, Fannie Mae would not buy and sell FHA and VA loans. They would only deal in conventional. And then Freddie Mac handles conventional loans through banks, mortgage banks, as well as savings and loan institutions. And they pool those loans together and they sell bonds against those loans. Bonds, a little more of a safe investment. Federal home loan banking system. So, what went wrong in 2008? It was the culmination of several years of lenders playing fast and loose with the rules. Lenders felt deceptively safe and secure about the mortgage market. Lenders thought, well, surely people won't stop paying their house payment. They'll let their Mercedes go back and get repossessed before they'd stop making their house payment. So let's just keep on making loans. If people want to buy houses, the most secure sector industry possible is real estate. Therefore, let's just loan money to as many people as who want to borrow it. Even people with bad credit, subprime loans, like bad credit, like really bad. Even they got mortgages because the lenders thought, well, what's the worst that could happen? Surely they're not going to default. And it all added up. It got worse and worse. They allowed lower and lower credit scores, more higher and higher risk. Borrowers could borrow money. There were things called stated income loans. And we, as real estate brokers, loved them for our own personal properties because it's pretty tough when you're making 100% commission, 1099 income, not W-2 income. When you're making 100% commission, lenders don't want to see you coming. They would rather not loan money to buy houses to people like me who are earning per sale 100%. It's hard for them to feel confident that I'm going to keep selling and therefore keep making the house payment and be able to keep affording the house. They put a lot more stock or feel much more comfortable in somebody with a normal W-2 salaried employee kind of a job. Even if that person made less money than I do, they would rather loan to that person because they feel that's more of a stable income, more guaranteed, right or wrong. So a stated income loan was essentially that. They would say, hey, okay, you're 100% commission, bottom of the barrel, low life. So, okay, we'll loan you the money, but you're going to have to make $400,000 to buy this house that you want to buy, to be able to afford this house. You're going to have to be able to make, a certain level in order to afford this $400,000 house. Do you make this amount? And as long as I stated it, yes, I do. Sign here, stating that you make that. Okay, sign. Here's your money. That was about it. Stated income. Do you make it? Do you promise? Okay, sign here. Here's your money. It was just about that simple. There were also loans in the range of 125% loan to value ratio. How much down payment's required when you borrow at a 90% loan to value ratio? What's the percentage of down payment if it's a 90 LTV? You got it, Talon. 10% down. What if it's 100% LTV? How much down payment is required? 0. What if it's 125% LTV? How much down payment is required? Also 0, plus they give you some. Right? Yeah, you're getting money and keys at closing. That's a pretty sweet deal for the borrower. The idea being help that borrower have some money to work with, and maybe they'll spend it on the house and increase the value of the house, but maybe they won't. Maybe they'll buy a car with it. Maybe they'll go to Disney or do anything else besides add value to the house with it. And some of them did the right thing, and some of them did the wrong thing. So all of that stuff kind of worked together to create this toppling industry. From 2008, 9, 10, 11, it was ugly, as you well remember. You might want to, if you haven't seen the movie or read the book, The Big Short, it's a pretty good behind the scenes. It's dramatized, but it's a little more interesting that way. But The Big Short is interesting to see how that kind of all fell together. That very small, select few people who saw it coming and bet against it. And so they won a bunch of money basically because they invested for failure instead of assuming the success that everybody else assumed. So a lot of foreclosures that this led to. And in the industry, a lot of people trying to avoid foreclosures. So I learned what short sales were after being in the business 12 years at that point. In 2008, I had been in it for 12 years. And I had never had to do a short sale. Didn't even know what one was because I didn't deal in the bank-related distressed sales. But we all got good at them because they were almost every other transaction involved one. Someone trying to avoid foreclosure or someone in foreclosure. And there are some brokers and firms out there that have good partnerships with banks so that those banks will give those firms all of their listings when they do foreclose, and they have inventory like real estate assets, which are called REO properties, real estate owned. The go-to real estate broker for those banks did really well. They had already established relationships with the banks, and so those banks just kept handing off foreclosure listings to them one by one, and they did a ton of business. Let's go ahead and have our little 10-minute break. When we come back, we'll talk about a couple other types of loans and finish out our 11, chapter 11. I'll see you in 10. Welcome back. We are back. Let's see. Okay. All right. Some more loan types. One benefit, as you remember, of the VA loan type was it allowed for zero money down. Well, there's another loan type that will allow that. It's called a USDA loan. USDA loans, they are not only for military. They're guaranteed by the USDA, government organization. They make direct loans, and they are for low to moderate income households. So it's a way to help more people who normally wouldn't be able to afford a house. And since they're low to moderate income, it allows them to put no money down. The USDA subsidizes the interest rate. It helps make it easier, helps make that interest rate more affordable. It's probably through a process of buying some points, right? Paying some discount points, buying down the rate. The USDA subsidizes to get down to a rate that the borrower can handle. But there's only so much per year. It is a budgetary item from the government. The government says we're going to allow X amount of dollars for USDA loans. And so maybe later in the year, someone who wants to get a USDA loan is out of luck because all the money has been used up. And that's what it means by inconsistent funding. Some other kinds of loans include these. A purchase money mortgage is a form of seller financing. Purchase money mortgage, just another type of seller financing. A bridge loan is something you might use if you need to sell your house in order to buy another one, but you can't get yours sold yet. So you can set up a bridge loan in the meantime while yours is still not yet sold, but you want to go ahead and close on the new one. It's just a little short-term loan, higher interest rate, short-term loan. Buy downs have to do with discount points. You can buy your interest rate down by paying points. And that way, let's say the rates are currently 6.5%, but the borrower can't afford the payment at 6.5%. But they could afford 4.5% this year. But they're expecting like a raise maybe before next year happens. So if they do what's called a 3-2-1 buy down, someone could buy down the rate for the first year, get it down to 4.5%. Then in the second year, it'll go up to 5.5%. Then in the third year, it'll go up to 6.5% and stay there for the rest of the time. So a buy down involves discount points. A reverse mortgage is what people who have maybe a paid for house, a house that's completely paid off, usually an older owner, someone who's owned the house for a long time, maybe a retirement age. And so you hear that story, a retiree gets a reverse mortgage because what a reverse mortgage does is pay them money. It pays the homeowner, the borrower, a monthly fee, a monthly payment. But every payment that they get paid is a reduction in their equity in the property. So it's only going to last as long as the amount of equity that they have in their property. Hopefully, the sad part is when you're talking about a reverse mortgage, you're trying to time it out. How much time do I have left on earth compared to how much equity is in the house that I'm getting a monthly payment from as my equity is decreasing? So it can be kind of sad to think about and to interact with. But if you get a listing and you find out that there's a reverse mortgage on it, you need to get some more details and kind of figure out the ins and outs. How far along are we? Is it toward the end of this reverse mortgage? Does this person need to sell really fast because they're about to pull the remaining equity in the house out with that last couple of payments? and how much will be left. They're not allowed to borrow the entire amount of equity in the house. There needs to be a little bit of cushion, but it still could be a pretty awkward situation. A package loan would be something you might get if you buy like a builder, new construction model home that also has the furniture included. So you just get a package loan that includes the house and all the belongings, furniture inside of it. A blanket loan is something that a developer would get, and they're going to borrow money to build the entire 100-unit development, all 100 sites. And then as they sell houses off to individuals, that's one less thing that's still under the blanket loan. They're able to carve off parcels one by one as they sell them. A construction loan is what you would get if you need to build a house. And it works this way. It's a short-term loan just for the duration of the construction period, and you are allowed to take what they call draws out from the loan. In other words, you get the proof of the construction loan. Now you need to have the foundation poured and built. So they're going to give you $20,000 for the foundation so that you can pay the people who did the work. You pull that out, you pay the vendor for the putting in the foundation. Now they're going to start the framing, do the flooring system and the walls. And so you'll take another chunk of money from the construction loan. Now you have to be paying interest on that amount of money that you've now pulled out to pay these different tradespeople. And then finally, at the very end, when the house is finished, that construction loan has gotten up pretty high, right? Because you've built a whole house and paid a whole bunch of people out of this loan. Now you're going to convert that construction loan into a normal 30-year or 20-year mortgage, just a typical conventional FHA or VA loan. So a construction loan serves the purpose of paying along the way for all the various trades that you need to pay to get your house built. Home equity loan is something you run into quite a bit. It's another way to pull equity out of your house. You're pretty much given a debit card, and as you swipe that card, you have less equity in your house. So when you go to sell your house, if you've maxed out your home equity line of credit, you're going to have to pay off that HELOC, home equity line of credit, HELOC loan with the proceeds from your sale. The equity stood there on behalf of the proceeds. It decreased as you swiped your card. So home equity line of credit is essentially a second mortgage. You have a primary mortgage that'll let you buy it. Then the home equity line of credit is a second mortgage for the amount of the equity that you have in the property. And people can use the home equity line of credit for all kinds of things. They could use it to improve and increase the value of the property. Maybe they want to put in a sunroom or a deck or finish the carport into a garage. But they could also use that money for other things like trips on vacation or cars or college education, some sort of an emergency fund. If you have some equity in your property, to get a home equity line of credit loan, the bank will probably say, well, okay, you have $50,000 of equity available. Let's get proof of that. And then they will loan you maybe $40,000. They'll allow you to pull as much as $40,000 of equity out of it. They're not going to let you pull the entire 50, probably more like 80% max. Not that you have to max it out either, but it's just maybe nice to have that as a safety net. And it's even better if you're going to use it to increase the value of the property itself. All the better. Some more terms. The word subordination means that we are moving a lower priority lien ahead of another one. Maybe your house was paid off and you had a home equity line of credit, but a paid for house, but then you decided to refinance the house to get a bigger chunk of money. And so that big refinance mortgage is going to insist that the home equity line of credit becomes subordinate to it, that the smaller loan is subordinate to the bigger loan. So a lower priority lien moving ahead of a higher priority lien for various reasons. And they're typically in line based on the date they were recorded. We talked about this already. that loan approval process starts with the loan originator doing an analysis, looking at the credit history, credit scores. They then check the housing expenses and compare that recurring expenses, recurring obligations to the monthly income. And then they do an assessment of the house itself in the form of an appraisal plus a title investigation. So different parties are doing these different tasks, right? The lender originator and the processor are both checking the credit history and credit scores, and also the housing expenses and the debt to income ratio. The appraisal is done by an appraiser, a third-party appraiser, and a title investigation, title search, is done by the closing attorney, whoever that is that the buyer chose. The closing attorney makes sure, as we know, that the buyer who's borrowing the money is buying it from the actual owner, seller, and that seller bought it from a seller and go all the way up the line 30 years back to comply with the Marketable Title Act. If there's a problem or cloud on the title older than 30 years, it's irrelevant because of the Marketable Title Act. So that title search, title investigation is handled by the attorney. Another issue that could come up with loans is this thing. The interest rates can change daily, hourly even. So what if the rate you're planning on borrowing is today 6.5%, but you're not closing for another 45 days? Is it still going to be 6.5% in 45 days when you close? Maybe, maybe not. If you're really worried about it, and if that really affects your affordability, then you could get that rate locked in for an amount of money. Pay a fee, an upfront fee to lock the rate. Sometimes lenders will say you get one free rate lock. We'll lock in the rate for 30 days. If we get to the night before closing and there's some kind of a delay in the closing for another week, for one thing, you're going to have to tell all the parties involved, and maybe the seller won't be too happy that now it's going to be another week before closing happens. Another thing that's a concern is, how long did your rate get locked for? Is it only locked through tomorrow, the original closing date? And if you extend the closing by a week, now the rate's not guaranteed. Now it might go up on you. So you could pay more money and get a rate lock extension to push out to the closing date. So that's a whole other bucket of worms, right, that can cause more problems, especially for buyers that are really tight on everything. They really ride in the line of affordability. If it's the seller who's the reason for the delay for some reason, then that buyer might say, well, seller, I had a rate lock set up that expires tomorrow. Now you're wanting to have a whole extra week to close. Well, you're going to have to pay for my rate lock extension because it's not my fault that we're extending, and now I'm going to have a higher interest rate because of that unless somebody pays to maintain the same level of an interest rate. There's a couple words that pop up when we're talking about borrowers getting approved, and one of those words is a pre-qualification letter. And another one is a pre-approval letter. Which one is better? Pre-approval or pre-qualification? Pre-approval is the preferred one because a pre-qualification is really based just on your conversation with that lender. That lender's saying, hey, how much do you make a month? Oh, okay. How much do you have for a car payment? Oh, okay. And that's about it. They're not checking to make sure you're right, you're accurate, or lying. They're not checking your credit score. It's very minimal, and it's really not worth even the paper it's written on. A pre-approval means more investigation has been done. They've checked credit score, and credit history probably. They've verified income and expenses. You've had to prove some things. And so to have a pre-approval letter from a lender when you're a seller entertaining someone's offer is a much better feeling of security that this is a good buyer, that you're confident in their success in getting approved for the loan. So you definitely should have a pre-approval before you submit an offer, especially in a market like ours. I doubt very many sellers will even entertain an offer that does not have a pre-approval letter with it. It's not required. unless the seller won't even entertain your offer without it. So it's not legally required. And maybe in a buyer's market, when it's the opposite market of what we're in now, we won't see them anymore. Maybe buyers will be like, hey, no, I'm just not doing it. But it's a good idea. I always encourage it. It's the best way to have a strong offer. Now, you need to know something for the next chapter about this. Your loan application, when you've applied for the loan, the lender's required to give that borrower a loan estimate document within 3 days of the loan application date. What is the loan application date? The date that the address of the property has been given when they apply for that loan. Long as the property address has been given with the loan app, that's the loan application date. And now the lender has 3 days to provide that borrower an estimate of all the expenses they're going to be facing in getting this loan. And like any time that you are denied credit, that denial must be given in writing. So if the loan does end up being denied, the borrower must be told so in writing. This whole process of the lender loaning money has seen a lot of highs and lows. Lenders have done it right and they've done it wrong. They've done it wrong quite a bit. The doing it wrong kind of led up to the 2008 stuff. And so things are put in place. Legislation has been put in place to make it a crime, and at the very least, sometimes a rule violation, something the lender is going to be held accountable for if they don't do things right. And one of the main types of legislation that dictates how lenders are supposed to handle borrowers and giving them information properly is called RESPA. RESPA stands for the Real Estate Settlement Procedures Act. Real Estate Settlement Procedures Act. It's also kind of in conjunction with another legislation called the Truth in Lending Act, TILA, T-I-L-A, the top line here. TILA, Truth in Lending Act, RESPA, Real Estate Settlement Procedures Act, all kind of work together to make sure borrowers are told the truth about the loan, any penalties, interest rates, how many payments there will be, what their payment is, and that they have plenty of information along the way to make a decision about accepting this loan and applying for this loan. There are some regulations within RESPA that we need to call attention to. Regulation Z says that all the fees associated with the loan must be disclosed. Must be disclosed. Before RESPA came along, lenders were maybe giving a borrower something they would call a good faith estimate, but that estimate might look different from lender to lender. Some lenders might do a better job of disclosing fees than others. And a lender that's trying to maybe look better, more attractive, and win the business from other lenders might hide some fees in the fine print and make it look like they're the best choice because they're the cheapest. But once that borrower chooses them and maybe gets several weeks into the process, then they find out, oh, they're able to charge me such a low rate because in the fine print it says that I've got to buy 3 discount points to get that rate. So that was something that could happen. And it was kind of too late almost for that borrower to turn back at that point. So they were kind of railroaded into paying some fees. And then some lenders have more what's called fluff fees than others. What is it really? Is it just another way for that lender to make some money? And so RESPA and Regulation Z dictates and requires that lenders say exactly what's going to be charged. They can't hide in the fine print anymore. In fact, that loan estimate document has to be the same one for every lender. So a borrower can see on page 3, midway down, that's where this item is. And page 1, that's where the payment's going to show up. And is there a prepayment penalty? That's going to be a little bit further down the page. So it's no mystery. Because way back in the early days, I would actually have to spend some time with my borrower and help them look through all those loan documents and find all the potential places they were being charged money. So now it's easier because their lenders aren't allowed to hide these things in the fine print. Regulation Z also gives us brokers some directions. We can get in trouble if we or lenders, whoever, could be brokers, could be lenders, if we advertise, for instance, a property by using the possible home loan payment. That's a great way to advertise, by the way. You ever see a car ad and it says, it doesn't tell you the price. It says this could be yours for $249 a month. That looks a lot better than a $24,000 price, right? Well, we could do the same thing with houses. And it works the same way psychologically. A $350,000 house has one psychological effect, but a $1,100 house payment, if that's what we put in the ad instead of the price, that looks a little more manageable. It might draw more phone calls, get more interested parties to call you and give you more buyer leads. And it is allowable. We're allowed to use the price, the interest rate, things like that. Finance charges, number of payments. We can use any of those things. However, we can't only use those things. What do I mean by that? Those things are called trigger terms. So can a lender or a real estate broker use an interest rate or a payment amount in their advertisement on a house? Yes, they are allowed to use trigger terms. But why are they called trigger terms? Because if you use one of those types of things, you have to show all of those other things. The interest rate, the APR, is affected by the finance charges and affected by the number of payments and affected by how much is financed. All of those things interact. All of those things are what show up on the promissory note, by the way. So if you choose to advertise a monthly payment, you have to also disclose these other things too. That's why it's called a trigger term. It triggers the requirement to show the whole picture. So if the test question says, are real estate brokers allowed to advertise with trigger terms? Don't think, ooh, trigger terms bad, so no, not allowed. That's not right. The answer is yes. However, they've got to use and include and disclose all of the other things that affect that monthly price too. If you advertise with a monthly payment, you have to also advertise the rate. You could put it in the fine print. You could put it somewhere off to the side or down at the bottom, but you have to include all of the things. So if you do any of these four things, the rest of them also have to show up. That's why they're trigger terms, and that requirement is under Regulation Z. Any specific numbers related to the loan must be disclosed alongside the other things related to the loan. Any credit-related terms, I should say. It's either all of them or none of them allowed. So, interest rate, monthly payment, number of payments, the amount being borrowed, all would have to be disclosed. But that only applies to those kinds of things. It doesn't apply to these items. You could advertise any of these three things, and these are not trigger terms, so you don't have to disclose that other stuff. If you do these, you could say, seller's going to pay all the buyer's closing costs. Well, that doesn't affect the monthly payment directly, the same way the interest rate does. So that's not a trigger term. Seller will pay homeowner dues for the first year. Also not a trigger term. Seller to pay or builder to pay a credit report fee. Same idea. So know the difference. Test question might say, which of the following is a trigger term that would require reporting all the other terms associated with that item? And so if three of them are these three, and then the fourth one is like number of payments, you need to be able to know which one is the trigger term, the number of payments. Basically anything that affects the payment itself. Interest rate, how many payments there are, or loan term, the amount being financed, the loan amount, finance charges, any of that stuff. Those are trigger terms. And you can also use just generic financing terms too. You can say low down payment possible. That's not a trigger term. No payments, low payments, no down payment. Also not trigger terms. The lenders are required to comply with something called the Fair Credit Reporting Act. Fair Credit Reporting Act. That lender has to comply with it, or they could face some disciplinary action. A couple things there. Standards of reporting your credit activity are set through the Fair Credit Reporting Act. It sets those reporting standards. It also establishes your rights as a consumer to correct errors on your report or to see your credit report. You get one free one every year and it's because of this Fair Credit Reporting Act. It also has to do with record retention. Any negative information that might show up, like lates, certain number of lates, was probably going to show up for at least 7 years on your credit report. And then if it's a bigger thing like a bankruptcy or a foreclosure, that might take longer, as much as 10 years to finally fall off of your credit history, credit report. Under the Equal Credit Opportunity Act, there are 3 additional protected classes that a lender may not violate. They can't choose not to make loans against these classes of people. In a future chapter, we're going to learn about what we brokers are required to fall within, and we can't discriminate against the federally protected classes of race, religion, color, national origin, familial status, disability. I think that's about it. There's 7 of them. Sex, that's the other one, including like gender identity, sexual orientation. So that's a real estate broker one, right? In real estate in general, not just brokers, but anybody in real estate has to comply and not discriminate against people in those categories. These categories are added to it for lenders. Lenders can't discriminate against someone's age. So let's think about that. I have a friend whose grandmother died at 105. Her grandmother bought a new house, a new construction house, at 99 years old. She paid cash for it. She had the cash. But if she had gotten a loan for it, that lender would not have been legally allowed to deny her the loan. She could not be denied a 30-year loan as a 99-year-old home buyer. Not allowed. Part of that is because what happens to a contract when someone dies? It just is beholden to the estate and to the heirs. So it doesn't really matter. Shouldn't matter, right? So lenders can't discriminate against someone's age. They also can't discriminate against marital status, married versus single, not making you the loan because you're not married, for instance. They also can't discriminate against someone who has some of their income or maybe all of their income from public assistance, government public assistance. They can't choose not to make the home loan because someone's income is from public assistance. And that's about it. Finally, this finance chapter draws out, but a couple things to remember. The Federal Reserve controls our supply of money in our economy. The primary mortgage market is that thing where we're making loans individually to consumers. The secondary market is when those loans are packaged up into big bundles and bought and sold back and forth. Other terms in the secondary market are Fannie Mae, Ginnie Mae, Freddie Mac. The types of loans are conventional, FHA and VA. Sorry, there we go. And on a conventional loan, it is not guaranteed by the government. An FHA loan is insured by the government, and a VA loan is guaranteed by the government. RESPA protects consumers in residential loans. We're dealing with residential here. That's what RESPA's for, not commercial. Regulation Z says that the loan terms themselves must be disclosed, and if you disclose one trigger term, you have to disclose all of them. But not everything is a trigger term. Only numbers related to the loan. And then the protected classes for lenders include age, marital status, and public assistance. Okay. A lot involved there. Let's move on to closing transactions. This, as well as contracts, is what we do in post 302. So I actually like 302 the most because it's sort of like real world. If you don't know how to do these things, you're not making any money. Closing the transaction, we're going to be talking about a little bit of level 1. We're going to get into RESPA again. A lot of level 2, the procedures of closing, pre-closing, settlement statement itself, the document that says what all the expenses and debits are, our responsibilities as brokers, and then our calculations. We're going to be doing some calculations about how to come up with what the buyer needs to bring to closing and what the seller is going to get from closing. All right. So the contract is signed. Good job. We have just started, right? On HGTV, they pop the champagne bottles and everybody's celebrating. I'm a little more nervous than that. I'm not celebrating until my check is in my hand, right? So there's a lot yet to be done. Probably pretty much all the work for a buyer agent needs to still be done. We've got some procedures required. Remember, the reason we're closing is to consummate this agreement from the contract, trading the deed to the property for the consideration from the contract, the money for the property. So we're transferring that deed or that title from the seller to the buyer, and we're doing that in exchange for the buyer giving the seller the money. So that attorney sort of acts as the quarterback in that whole thing. They are dispersing all the funds and reflecting all of the various funds in the transaction required to pull off this closing. They have looked at the contract itself, and between that and talking to the different real estate brokers, the listing agent and the buyer agent, they found out, okay, well, there was a home inspection, there's a home warranty the seller's going to pay for, and then they had some repairs needed, and so they negotiated repairs, and the seller agreed to pay for a warranty in lieu of fixing some stuff, or maybe the seller agreed to pay some closing costs for the buyer instead of fixing some things. You need to tell the attorney all of these things that happen along the way so they can account for them on this settlement statement. Settlement statement is the one document that has all of the various pluses and minuses from both sides. Each side gets one. The buyer gets a closing disclosure. The closing disclosure looks a lot like the loan estimate, plus all of the pluses and minuses of the expenses and credits, the debits and credits. The seller gets a settlement statement too. They get a CD or a closing disclosure, also known as a settlement statement, showing what they're going to end up with. So the last line of this CD for the seller shows what the seller hopefully is going to walk away with. In 2008, unfortunately, many sellers didn't walk away with any money. In fact, it told them how much they needed to bring to closing to basically buy their way out of their house because they owed more than they could sell it for. And they didn't do a short sale. You don't have to do a short sale if that's the case. As long as you have the $3,000 you need to bring to closing as a seller, that's what some of them would do. But hopefully it's a more happy closing when the seller actually gets a positive check from the closing proceeds. Sellers get a little grumpy when the real estate agent makes a bigger commission than the seller ends up getting at the end. But hey, they could have hired anybody or done it themselves, right? So the best way of terminating a contract and agency agreements is to have that successful closing. And that closing requires that the attorney shows where all the money went in the transaction. Remember, settlement versus closing. What's the difference between the two? Settlement is the signing of the papers, the execution of the documents. Things are signed, including the closing disclosure. And those documents are delivered to the closing attorney, meaning that's who's really kind of probably conducting the signing. Sign here, here, and here. Probably the paralegal or the attorney. It's the people getting together and signing things. Then the closing happens afterward. Now they They check for one more time to make sure no additional liens have been put against the property. They verify the loan has been funded by the lender, that they really did give the money and wire it into the attorney's account. They finally record the deed at the courthouse, and once that deed is recorded, now the seller gets their check, and now the brokers get their commission, and now it's safe to go ahead and give the keys to the buyer, because closing constitutes, or deed recording constitutes the closing, the deed being recorded. Officially, giving the buyer the keys and possession should happen only once the deed is recorded at closing, after it's been closed. But sometimes, if the parties agree, if the seller feels comfortable, they could go ahead and let the buyer get the keys before the recording. You as a broker just want to make sure that you explain to everybody the potential downside of that. But it's not your job to enforce it. You could certainly give them your advice about it, but you can't keep somebody from agreeing, the seller and the buyer from agreeing. Let me go ahead and have the keys, even though it's not going to record for 2 or 3 more hours. I'm sure it'll be fine. Could be their attitude. It's up to them. We know that during that due diligence period, whatever amount it's been negotiated to, it's when that buyer is investigating the property, and they're also incurring some expenses. They're hiring inspectors, hiring a surveyor, hiring an appraisal. Have to pay for some of these things ahead of time. In real life, they're probably paying for the inspection ahead of time. They're paying for that appraisal and a credit report fee. Appraisal's probably $400 to $600. The credit report fee is probably $50 to $100. And deciding during this period of time, do I really want to go through with this all the way to closing? Terminate now while I can still get my earnest money back, or proceed? And that termination includes a time is of the essence, 5 p.m. on the date of the due diligence deadline. So it's during that due diligence process that the buyer makes a lot of choices. With the agent's guidance, right? They're choosing an attorney real soon, right off the bat. They've hopefully already picked a lender. Sometimes you get under contract and the buyer still hasn't chosen which lender they're going to go with. They need to do that pretty soon so they can use the entire time of under contract to, and especially due diligence period, to find out if the loan is looking pretty strong. Best chance possible that it's really going to be approved. Inspections, survey, homeowner insurance. They need to go ahead and shop for homeowner insurance. And remember, there is no loan contingency with the standard offer to purchase. In other words, if the buyer can't get their loan approved, they still don't get their due diligence money back. And if it's after the due diligence period, they also don't get their earnest money back if they choose not to buy it because they can't buy it because the lender won't loan them the money. So let's make sure as much as we possibly can that it's during the due diligence period. We have enough time there to figure this out. Buyer can't get financing. If they're backing out for any reason, including that reason, they need to give written notification by the due diligence deadline, 5 p.m., so that they can have a shot at getting their earnest money back. And they're looking to check all this stuff. It's all these things. Investigating the property might be also a wood-destroying insect or a termite letter, another word for it. Is there a septic system? Let's get a septic inspection. What kind of insurance estimate will there be? Maybe there have been so many claims against the property that the insurance is going to be expensive, more expensive than they thought. So much more expensive than they even want to pay, so they back out of the purchase. That might pop up when they have when they find out that it's a flood zone. So they have to also, in addition to normal insurance, get flood insurance on top of it. And that flood, I've had one where the flood insurance was another $3,000 a year on top of the normal insurance. But that owner was lucky because it just so happened in that case, the state of North Carolina gave them some sort of a special flood insurance subsidy program. So they only had to pay 1/10 of that. So it was only $300 more a year, 300 more instead of 3,000. So best time to figure that out is during due diligence period too. What are the utilities? It's not uncommon to ask what the average utility bills are. Are there any easements? That's going to come up from the survey. Is the road privately maintained or publicly maintained? Because if it's only private, that means the neighbors have to pay for it, and it's expensive to repave roads. So let's figure that out. Does the buyer want to have to deal with that while they own the property? And if not, again, another reason to back out. Just anything and everything that could keep them from wanting to actually buy it. That's what we're talking about. Another good idea is to have you could call it a termite inspection, but there's more than just termites that can destroy wood. There's powder post beetles that eat wood. There's carpenter bees that bore holes into wood. Termites. So to call it a termite letter you're probably dealing with an old timer, but it's officially called a WDIR, Wood Destroying Insect Report. Are there pests that are destroying the wood? Because the wood is probably the basic structure, and that could eventually cause noticeable problems. So on this wood destroying insect report that you can't really see that well, what is it reporting? It's not reporting that there's a guaranteed absence of wood destroying insects, because that inspector is not required to pull the cabinets off the wall and look behind everything. In fact, that inspector doesn't even have to pull and roll the toolbox away from the wall in the garage or lean the ladder away so they can look down at the baseboard. The termites are funny little critters. The process there is, let me share something with you. It could be that if you could look through the garage while it's empty, what they do is they like to look down at the baseboard. That's like the around the floor. You can kind of see, maybe this is a more clear image. Not really, but obviously that's a gray garage floor, and the floor of a garage is frequently not connected to the footers or the foundation at all. It's what they call a floating slab. So there's a bit of a gap, a tiny little gap between the concrete of the floor and the concrete of the edges. And in that gap, over time, the little filler they put in can get worn away, and the termites like to go up through that gap, eat through that stuff, and find the wood of the house. And so what's happening here is they have taken soil from the ground and created these tunnels that they travel within. And those tunnels can go way on up into the walls. They just go back and forth in those tunnels, coming up, eating the wood, going back down in the ground, getting some more water, drinking the water from the ground, and eating the wood from the house, back and forth. Maybe they do it once, and it's just one little bit of termite damage. Maybe they do it lots of times back and forth over the years, and it turns into lots of termite damage because nobody noticed it along the way. Here's a better shot of a termite tunnel. If you were to kick that with your foot, if the termites are still using it, you'd see the gross little larvae-looking termite thing in there. Or they might not be using it anymore. It's just a dirt tunnel. So the question is, how far up into the wall did they go? Looks like they've eaten right here at the top, and some dirt is kind of making its way out there too. So I have a feeling they're going way up on into the wall quite a bit. And they can do a lot of damage. I'm looking for here's one where they came up into the floor joist. And so those tunnels, this is kind of giving me creeps, but here's one in a garage again. They come up through the gap, they made their tunnel, and they got up to the wood. That's what they're looking for. That's what, well, they're not looking because they're blind. That's what they're sniffing for. Here's a termite that got away. He's wearing a hat. I'm just kidding. That's a human. He's scraping those tunnels away. And here's what I want to show. Here's what they're doing inside. They're turning that wood into like cardboard. They're just they're tunneling their way, and that wood loses all structural integrity. In fact, if it's been long enough, you could poke through it with your finger. an inspector is going to poke it with a screwdriver. And if that screwdriver can go into the wood, they're going to write it up and say, yep, we've got some termite damage here. There's another bad one. They've just turned it into just nothing structural anymore. And so that's why it matters. Here's one that's actually in the floorboards. So, wood destroying insects, big deal. It is a big deal. Termites are a big deal in this state because of our climate. It's very conducive. So what is this wood destroying insect report saying? It's saying, from what I can see with the naked eye, without moving anything out of the way, because you know how some garages are, that's completely full of stuff. And they're not even required to pull the things away from the wall to see down at the floor and at those baseboard moldings to see where those tunnels are. They're just going to look at what they can see, and that's it. So the report is just saying, from what I can tell, and they'll make even a little note on the back and say there was some stuff in the way. They'll say more of a formal way of saying that. So what does it not report? That there are absolutely no wood destroying pests, because again, they're not to do a truly thorough job. They'd need to pull like all the cabinets down, all this stuff that would basically be way more than anybody wants done. It's just going to report what they could see on that date. It could be that there's no termites today when he went out there, but tomorrow they showed up. So hopefully we've figured out from all the inspections during this due diligence period what we want the seller to fix, what the buyer wants them to fix. And we just need to get that in writing so that now the seller has until closing day or the walkthrough before closing to get those things done. They just need to make the promise right now before due diligence period ends. And that's what we're doing with this second set of negotiating. We've done the first set back when we brought our offer. Now we're doing it again because of the repairs that are being asked for. And the seller can make choices. In fact, that contract, standard contract 2T, specifically says this is an as-is contract. What you see is what you get. But you still have the right to ask the seller, but the seller has the right to say no. They're not required to fix anything. So the seller could say, yeah, I'll fix it, or no, I'm not fixing it, or I'll meet you somewhere in the middle. I will negotiate somewhere in between, give you some money toward it, or give you some sort of an allowance. And it just depends on the kind of market. In a market like we're in now, especially with buyers giving $10,000, $50,000, $100,000 of due diligence money that's non-refundable, sellers are a little less inclined to make repairs. So when are those negotiations of repairs completed? By the end of due diligence period, preferably. When are the repairs completed? Before closing, before settlement. And then the seller's options are to say yes, no, or somewhere in between. If repairs are needed, then it's probably a good practice for you as the broker to get in that house and make sure they were done. Or you could also, the buyer could pay the inspector to come back and verify that those things that he suggested done got done. Have an inspector look at it. But at the very least, probably bad idea to not do your final walkthrough and verification of repairs until like an hour before closing on closing day. Because then what if they didn't fix something, or they honestly missed it? Not just that they were trying to scam you and pretend they didn't see it or didn't fix it, or they meant to, but they didn't know that they were supposed to. Then you don't have much time to get it fixed, get it worked with. And then your buyer is probably a little more inclined to, they'd still be mad about it, but they would probably still go through with the closing because they've got all their stuff on a moving truck. If they don't close today, they're going to have to pay for 2 moves. They've got their loan already approved. If they don't close today, that loan process is going to have to restart. There's a lot of reasons a buyer feels the pressure to go ahead with closing if we don't find out that things weren't repaired until the day of closing. So as a good buyer agent, when you get word that things have been fixed, if it's hopefully a week or so before closing, get out there and make sure they were fixed. So now if the seller did forget, either intentionally or accidentally, or missed something on the report, you can say very passive aggressively, oh, that's okay. I understand. Mistakes happen. At least we have a week for you to get this thing fixed like you should have already, right? And then at the final walkthrough, make sure everything is all squared away. Still, I would rather that be the day before instead of on the way to the closing, but you do need to have a final walkthrough. And we know this. I've quizzed you on this to the point where you're like, oh, really? Again, we know. Need to have all this stuff done as best you can by the due diligence deadline. If you go past it, now the earnest money is in jeopardy. That's all the buyer's stuff. That's what all the buyer and buyer agent are worried about. The seller's issues, basically making sure the buyer really can buy it with money promised, both down payment that they say they can make, as well as the loan can get approved, and then making sure that all those terms and promises in the contract actually get fulfilled. By the way, the seller might have required a pre-approval letter, but what if that buyer is putting some money down, like a 20% down payment, and we saw a $500,000 house, that's $100,000. How about maybe get a proof of funds letter proving that they really have $100,000 in the bank? So a good listing agent is going to not only ask to see a pre-approval letter, but also a proof of funds letter for both due diligence money and the down payment. Heck, and the earnest money too. Let's make sure that money really exists instead of just promises they're making before they get us under contract. Once they get us under contract, if it turns out that money's not there, you're still under contract until they officially can't perform. And you could be tied up for days or weeks until that all finally goes away and ends and the contract is over. In the meantime, your seller couldn't really do much about selling it to someone else because the contract still existed. So let's make sure people are able to perform. Some documents are handled by the attorney. Lots and lots of documents. For the seller, the attorney well, for the buyer, they're preparing the deed, but the seller pays for the preparing of the deed. So the deed preparation is a typical seller paid expense. Write that one down. What are the things that the parties have to pay for? There are some typical standards, and seller pays for deed preparation. I think of it like if you're selling a car, you wash the car probably. You want to make it look nice. You get the McDonald's fries out from the floorboard, right? You're vacuuming it, you're washing it, you're preparing it for sale for the most you can get out of it. So that seller wants to pay for that deed to be prepared that's going to convey it from them to that new buyer. The attorney is doing most of their work for the buyer because it is the buyer's attorney. The buyer chooses them. But there's not that much needed from the seller side, so little that it's okay to let the same attorney, even though it's officially the buyer's attorney, to let that same one do these things for the seller. And we'll talk about the rest of those when we come back, and I'll see you in 10 minutes. Welcome back. Our last little bit, last 45 minutes or so. Wake up. Time to get going. Time to pay attention. I know this is a hard time of night. But this is a good topic. This is what you're going to be dealing with a lot. Some of that stuff that we talked about the first couple of weeks, anything that's involving an attorney, yeah, we need to know it for the class, but in real life, you kind of just don't need to deal with it. But this is regular, real stuff. So that closing attorney, that settlement agent is preparing the various documents. They're preparing the deed, and a deed preparation fee in real life is probably going to be $300, $400, $500. On the test, they'll give you a deed prep fee that you'll need to put under the right column, buyer or seller, and now you know it's going to be under the seller's expense column. That's called the debit column. If there are any leases, maybe it's an investment property, that settlement attorney is going to make sure they get a hold of all of these various documents and make sure that the parties get what they need. They're also going to order the final payoff of the seller's loan. Now, if you have a house payment yourself right now and you look on your statement every month, it'll show you what your loan balance is. But that's not necessarily what your final payoff is going to be. Because when you order the final payoff, or when the settlement attorney does it, or actually it's going to be the paralegal that they hire to do all this work, when that final payoff is ordered, it's going to include probably 2 or 3 days extra of interest, because that final payoff gets overnighted to the lender. And so they don't want to do themselves out of any more money than possible. So you frequently, as a broker, have to explain to your seller client, yeah, the payoff probably looks a little different than you expected because there's going to be a little bit of extra interest built into it. If the parties to the transaction have agreed to also include like a desk or some furniture, some couches, some tables, the dining room set, then probably the lender is not going to allow those things to show up in the contract of the real estate. Lender's going to say, are you buying a house or are you buying a dining room set with a house around it? They won't say that. But their attitude is, we want that contract to pretty much just reflect the real estate. About the only personal property that a lender is comfortable with being mentioned in the contract is the washing machine, the dryer, and the refrigerator. Maybe. But if you get creative with pool furniture and the sectional couch and the big desk, big L-shaped desk, they're usually going to kick that back and say, because that buyer agent needs to send the contract to the lender as soon as it's under contract. Lender's going to say, we don't want to see that stuff here. Get it out of here. Remove it from the contract. Well, if you're removing these personal items from the contract, but the parties have agreed, how do we reflect them? How do we make sure the parties have something in writing that they're really going to leave them behind after closing? That's going to be a bill of sale, a separate document for the personal property called a bill of sale. And so for you, the broker, as a buyer agent, that's probably the one that's more worried about it. The buyer wants to make sure the seller really does leave it behind. So good move here would be to contact the closing attorney and say, hey, do you guys have a standard form, like a standard generic boilerplate bill of sale, or could you write one up for us? We're closing with your firm in a few weeks, and frequently they'll do it for free. They'll do that kind of thing just as a courtesy sometimes. Depends on how much business you've done with them, but that's a good first try if you need to come up with a bill of sale. The other thing the settlement attorney is going to verify is that you have no mechanics liens against the property. Remember those? So they're going to ask this question. They won't necessarily say the word mechanics lien, but they'll say, hey, seller, do you have any unpaid bills over the last 120 days? But remember, that's what that's about. A mechanics lien, a vendor or a work person can Maybe a roofer, maybe a plumber or an electrician could say to themselves, well, I don't think they're going to pay me. Let me go ahead and file this lien within 120 days of the last work that was done on the property. And if they don't pay me, I can execute that lien and have an active lien against the property. That puts me in my place in line as of the first date of my work or materials provided. So they'll ask this question, and the seller has to sign it at closing too, settlement. They'll sign a document that says no unpaid bills in the last 120 days. So those are pretty much the most common seller documents we're dealing with. And here, the little image there on the right, you can see the typical deed has this language. It probably has about a half a page at the top that's just blank. But starting halfway down, it's got this stuff. And it has this, is it a general warranty deed? If it's not, they'll say it's a special warranty deed or whatever it may be. And then it goes through the various elements that are in a deed. The seller documents, a lot more. I'm sorry, buyer. The buyer documents, a lot more buyer documents, because especially if they're getting a loan, probably 2 or 3 inches thick worth of documents. And that settlement agent's paralegal is getting what's called the loan package from the lender. That's the question. Everybody always asks, did the loan package come in yet? That's all of the various documents the lender requires to be signed. It's more than just the promissory note in the deed of trust, although those are certainly the most important and they're included, but it's a bunch of stuff, as well as these other things, the title insurance policy, the property insurance. You as a broker for a buyer, you say to your buyer, hey buyer, I know we picked a closing attorney. You've applied for your loan. Now you need to go ahead and shop for homeowners insurance. Good starting place there is to maybe try with whoever does your car insurance. Maybe they'll give you like a group rate or a group discount, package discount for doing car and house. And so get a quote, figure out who you're going to use, and let's connect that insurance agent with the closing attorney. And that insurance agent will put together the policy for covering this home and then send it over in the form of what's called a binder over to that settlement agent. And that's how that settlement attorney knows how much to put in for the math, right? Put into the closing statement for the various items that we need to charge for. For property insurance, it's going to show up in a couple of places on the settlement statement. Remember, what's your monthly payment composed of? The typical monthly payment is composed of principal and interest, but also what else? Principal, interest, what and what? In the chat's fine. Give me something. Nothing? Come on, guys. PITI, principal, interest, what and what? Taxes, good one. Insurance, there it is. And here's one of them. Here's where that shows up. We're in the closing disclosure, in the settlement statement, it's going to show up if that the lender is setting aside some of the insurance money, need to collect some insurance money from the buyer to create the escrow account that the lender's going to hold it in, so that when that insurance bill is due that year, they have enough money to pay it with. And so it's going to show up in the escrow section, a couple of months worth of homeowners insurance. It's also going to show up in the prepaids section, because they typically need to collect the entire first year of insurance premium at closing. Might be like $870 or something. Collect the first year of homeowners insurance premium. So that attorney is following the instructions of the lender. How much do you want to collect for tax escrow? 4 months? Okay. 3 months? Fine. Insurance escrow. 8 months? 9 months? It all depends on when the closing is within the year. So the lender gives the attorney a list of all the various things and lender fees that they want the attorney to collect for. There might be a wood destroying insect inspection that the buyer had done. And so the buyer agent will send that to the closing attorney. Or a survey. When you order a survey in connection with a sale, the surveyor will ask you, who's the closing attorney? I'll send the survey directly to them as well as the buyer. And then at closing, the attorney can explain the survey to the buyer. You should never explain a survey to a buyer because that would be called interpreting the survey, and we're not authorized to do that. So an attorney can, or the surveyor can do it. The title insurance, that's that thing that is the result of the attorney doing a title search, making sure the property has a clear chain of title. This current seller bought it from a seller before them, who bought it from a seller before them, way back and back and back and back. Is it a clear chain? Is there anything unexpected within that chain of title? And so as long as the title insurance company can see from the title search that the attorney did that everything looks nice and clear, they will issue the title insurance policy. And here's the thing about the title policy. 2 people care about it. The owner, the future owner, the buyer, as well as the lender that the buyer's borrowing from. So there's going to be 2 different title insurance policies that get paid at closing. One of them is covering the lender, and it's only for the amount that the lender cares about. What do you think the lender cares about? How much dollar amount does the lender care about in a transaction? What dollar amount? Full sale price, or there it is. Yeah, that loan amount. You got it. So that title policy that benefits the lender is just going to be for the loan amount itself. And then what else? What happens to the loan amount over time with every payment? It decreases. So that title policy for the lender is going to eventually go away altogether, because once the loan gets paid off, the title policy for the lender doesn't need to exist anymore. So that coverage for the lender decreases with every payment. But the borrower's policy, the new buyer, the new owner, their policy stays the same. It's consistent. It covers the sale price, the value of the property consistently as long as they own it. By the way, it's not a monthly fee. It's just paid one time at closing. It's a pretty good deal for what it is. You're getting insurance, some company to stand behind your title being clear now and forever, because you're paying that one-time fee. The attorney did the title search, so the title insurance company feels pretty confident that they're not going to have to pay out for anything. So that's just one more step in the process. These are the steps we learned in Chapter 5. That deed or that title needs to comply with the offer to purchase. How does the attorney decide what goes on the deed? They look at the contract. So what's the most important document in the sale? The contract, because it informs the deed itself. Then the attorney investigates the history of the title. They issue an opinion. The attorney says, I've looked at it. It all looks clear. I think, Mr. Title Insurance Company, you're safe to give them a policy. And the title commitment is made based on that attorney's opinion. Title insurance company says, yep, okay, we'll issue them the title policy. We're good. So there's that initial title search done along the way during the due diligence period, during the under contract period. Then right before the final closing happens, the deed is recorded. Before that deed gets recorded, the attorney does one more quick search, one more check against the title to make sure no additional liens have been added to the property. Then the deed gets recorded. Now we have a closing. Okay, the process of conducting this closing. The buyer decides all of these things. The buyer picks the attorney. The buyer proposes what date the closing is going to be. And I say that, I mean the settlement. What date the settlement's going to be. Buyer's choosing all of these things, typically. Now, if it's new construction, sometimes the builder will say, well, I'll give you money toward the closing, but I want you to use my closing attorney. And that's allowable. It's just all negotiable between the parties. But our typical contract has the buyer picking the closing attorney. In other states, they do something called an escrow. That's what they call their closing day, is completing escrow. And it's done by an impartial third party. We don't have impartiality here. North Carolina, somebody represents somebody. And what we have is a settlement meeting with an attorney that has been hired by the buyer. And they officially represent the buyer and the lender. But they still do a little bit of work for the seller because there's not much needed. But with that said, does it have to actually be an attorney who conducts the settlement and says, sign here and here and here? And the answer is no. It could be a paralegal. It could be not even a paralegal, but just a non-attorney, which we would call a settlement agent. But if it's a settlement agent conducting the closing, they need to have a speed dial availability to an attorney in case the parties in that settlement have any questions about the legal parts of things. They can't give an attorney's opinion because they're not an attorney. But the closing or settlement agent could be a non-attorney. The attorney still has to do all the document preparation, but they don't have to actually conduct the actual settlement. They just need to be under their supervision of an attorney and have access to one in case of legal questions. What about this? No, not this one, the next one. But this one's saying that the buyer and seller do not have to be across the table from each other. And frequently, especially since COVID, but even before then, the procedure had kind of morphed away from buyer and seller being across the table from each other at closing to they might see each other in the waiting room, but the attorney usually calls the seller back first and the seller signs their papers. Probably takes like 15 minutes. And then they leave. And then the buyer comes back and they sign all of their papers, which probably takes more like 45 minutes to an hour. So no, they're not required to attend settlement together. But do they all go, or do they all handle a settlement or sign things? Yes. They could sign their papers either separately. Sometimes the seller will come maybe a day or two before the official settlement date and just sign a little bit that they need to sign. They could even be out of state and the attorney could overnight the documents to them, and they might need to sign some things in front of a notary and they would have to work that out, but then they could throw it back in the envelope and overnight it back ahead of the settlement date. So all of that is possible. It's flexibility there. They could also give a power of attorney, limited power of attorney to somebody to sign for them if they can't make the date. We as brokers, though, the Real Estate Commission says if you don't show up to that closing, you have violated your fiduciary duties as a broker. We need to be there. And even if it weren't for the Real Estate Commission having such a strong stance on this, I have saved a lot of closings just because I was the only one in the room that had the document needed to keep going forward. If it weren't for having this document at hand because I had it in the file, the closing would have gotten delayed, maybe fallen apart altogether. So it's just good for us to be there as a resource. We might be the only one that has that one document signed by everybody, right? That is needed in that moment. Because it's a time-sensitive situation. We have this approval to close on this day by the lender, And if we need to bump the closing to another day, that lender might say, well, then we need to push it back through underwriting, and that's going to take a few days, not just bump it to tomorrow. It's going to take through the weekend or another 3 or 4 or 5. So a lot of things can pop up. And so it's good to have all the possible documents and signatures at hand. So just be there. It's just good business practice. Plus the real estate commission could get you in trouble if you're not. Lots of little nuisance problems are solved by brokers at a settlement. Hopefully, though, if it goes smoothly, it's nice and boring, and you just sit there not having to do anything except maybe chime in and help your client understand the attorney's explanation of the various items on the closing statement. What are we doing at this closing? 2 things. Making sure all the promises were fulfilled. Did the settlement statement show that the seller did actually give the buyer $5,000 toward their expenses? Did it actually show that there's a home warranty on there paid by seller for the buyer? And that's all because of the brokers. Ahead of time, they sent these invoices over, made sure the attorneys had these things in place. And so this closing is those promises fulfilled and that buyer's loan being finalized. And finally, that deed being recorded, because the deed and the deed of trust both get recorded. And the deed needs to be recorded prior to dispersing funds. You're not getting your money until the deed is recorded. Money is not allowed to be released until the deed is recorded. And that falls under this thing called the Good Funds Settlement Act. Deed must be recorded prior to dispersing funds to make sure the funds are good, right? To make sure there's really money standing behind those things. That last step between settlement and closing, title is updated, deed is recorded, deed of trust is recorded, any sort of liens paid at closing are canceled, and funds finally are dispersed, and that sale gets reported to the IRS. This settlement statement, also called a closing disclosure, shows every dime, every nickel and dime and penny that was either paid for or by the parties, a credit or a debit. A credit is just money coming into the party's account. A debit is the money leaving them, an expense, for instance, just like your checking account. Money coming in or money going out. So that closing disclosure is showing all that money one by one, line after line. Settlement agent is also dispersing any funds that they might be holding in their trust account. Maybe they were holding the earnest money this whole time. They're going to disperse that earnest money and use it as part of use it as a credit to the buyer's side. They're going to count it as a credit to the buyer's side at closing, that much less money that the buyer needs to bring with them to the closing. And then everybody signs the closing disclosures, various copies. So everybody gets a copy that has been signed. Okay, let's talk about RESPA. RESPA, the Real Estate Settlement Procedures Act, the legislation that makes the lender disclose things completely, fully transparent, and also requires brokers and lenders to, any advertising they do has to be properly disclosed too when it comes to trigger terms, but protects consumers against abusive loan practices. Make sure that consumers aren't lied to, that they see what all the various fees are that the lender charges. First enacted in 1974, revised as a result of 2008, but to provide accurate estimates for those charges. Make sure that kickbacks aren't happening between the various service providers and real estate brokers. If we recommend a home inspector, is it because we know that home inspector does good work, or because that home inspector pays us $100 for sending them a piece of business? It better be because we know the home inspector does good work. We can't have kickbacks between various service providers. Warranty companies are a little bit different. Warranty companies actually can pay a broker a little bit of money for connecting them with a client only because the broker officially kind of does a little bit of work for it. The broker has to maybe take down the serial number of the appliances that the warranty is going to cover, maybe fill in the application on behalf of their client. So that's some gray area that's a loophole that a broker is allowed to potentially get paid like $50 from a warranty company for selling a warranty to their client. I don't do it anymore. There was a year where I made like $2,000 or $3,000 just from warranty company bonuses like that. But the commission since then has decided they really are kind of nervous about that sort of thing. And usually if it's one of those warranty companies that they'll either give the broker a little fee like that, or they will let the broker sell the warranty to the client for a lower fee. The client gets to pay less for it, or the broker gets a chunk. I'd rather the client just get a better price, frankly, and eliminate the issue altogether. But RESPA says no kickbacks from typical service providers to brokers. It also restricts the lender from collecting more than is absolutely necessary for the escrow accounts. Remember that thing about PITI? Let me show it to you here. We've got our principal, interest, taxes, and insurance. And this part is the payment, right? It's the principal and the interest. But the taxes and the insurance, every month, that monthly payment is going to include 1/12 of the annual taxes and 1/12 of the insurance, along with the principal and interest. That is used it's going to be added to an escrow account that the lender has set up. So these monthly taxes and insurance chunks, little bits, are going to be added to that escrow account. How did that escrow account get started? At closing, from the settlement. And at the settlement, the lender probably instructed the attorney to collect maybe 3 months of taxes and 5 months worth of insurance. They'll say something like that in their closing instructions. So the attorney will say, well, okay, 3 months of taxes. How much is the tax bill? Oh, it's $1,200 a year. Okay, well, what's 1 month's worth of taxes? 1,200 divided by 12. Oh, that's $100 a month. So they want me to collect 3 months. So I need to collect $300 to go toward the tax escrow. I'm going to send that $300 to the lender. The lender's going to set up this tax escrow account. And they also want to collect 5 months of insurance. Okay, well, the insurance premium for the year is $870. So what is that per month? Oh, that's $72.50. And we need to collect 5 months of it. Then I will also collect from the buyer's side at closing $362.50 for the insurance. And we're going to send this and this both to the lender. Going to take it from the buyer. Buyer's going to have to bring that to closing, among all the other things they're bringing to closing in terms of money. And we're going to collect this $662.50, send it to the lender so the lender can put it in the escrow account. And then for every payment that buyer makes throughout the year, those 1/12 of taxes and 1/12 of insurance also get added to the escrow account. This served as upfront sort of cushion. They needed to have a little bit of cushion in the account so that when the bill comes due, that tax bill comes out September 1st, it can be paid. And there's enough money there to pay it with a little bit of wiggle room. And that escrow account will have that cushion in it for the whole time that buyer has this loan. And then maybe, say, 5 years later, that buyer decides to sell the house. Now the buyer decides to sell. Well, at closing of that one in the future, the taxes are going to be settled up. They're going to decide who has to pay taxes, as we will learn here in a minute how we do that. And that money in the escrow account is going to, whatever's left that didn't get used, the cushion amount, is going to be refunded to the buyer. probably within about 45 days after closing. So that buyer will get that cushion back later once they sell the property and pay off the loan. So that escrow thing, you better believe that if the lender could get away with it, they wouldn't just say 3 months and 5 months. They'd say probably 3 years and 10 years, right? Because the more money they can hold on to, the more money that they can invest in other things and get interest on. So they're not allowed to do that. They can't play those games with our money. And so RESPA says, hey, lender, you can only collect a certain amount to go toward these escrow account deposit cushions. When you set up these escrow accounts, you can't just collect a whole bunch of money. Under RESPA, there's something called Regulation X. It just talks about the fact that RESPA covers residential property. That includes 1 to 4 unit dwellings. It could be duplexes or triplexes and 4 quadplexes. Typically 5 or more family dwellings are considered commercial. So just 1 to 4 units, including single family homes, including condos and townhouses. And RESPA also applies to properties financed with a federally related new loan. But I know what you're thinking. You're thinking federally related, that must mean FHA, VA. And good job. Typically that is what that means. But in this case, when it comes to RESPA coverage, the requirement that we follow RESPA guidelines, federally related new loan also includes conventional loans. Because as a result of that whole 2008 catastrophe, one of the results of that was new legislation called the Dodd-Frank Act, which kind of reset the whole lending process and said, hey, a couple things happened as a result of 2008. One of the things that were going wrong, that people were doing wrong, is lenders would hire appraisers directly. Think about that. What if a lender who is going to be making a loan to someone where they're going to earn interest, they're going to get paid an origination fee, they're going to then make interest every month. What if an appraiser doesn't make the appraisal come in on the sale price? The appraiser can't justify the sale price, and they say, I'm sorry, you want a sale price of $500, the best I can justify is $475. So, and then the parties can't agree, right? The seller won't come down. The buyer can't afford to add more to their down payment. So this is a dead deal. Back in the day, do you think a lender would probably maybe lean on that appraiser a little bit and say, hey, appraiser, are you sure about this $475? We stand to lose a lot of money if we can't make this loan. Are you sure? Don't you want to just reconsider? Can't you get that appraisal to work through? Can't you maybe ignore those comps you were looking at, pick some better comps? So sort of like an undue influence kind of thing, which would basically be fraud. You'd be defrauding the investor. Because think about this, the lender is not necessarily the investors whose money it is. The lender's the one bringing the two together. They're finding the investor that the money's coming from, and they're pairing them with the buyer who needs to borrow that money. The lender's the one who's facilitating this transaction. And so if they tell the investor that it's really worth $500 when it's really only worth $475, they've defrauded the investor just for the purpose of making the loan so that they can earn the interest. So that happened. A lot of loan fraud was happening. And by the way, loan fraud, federal loan fraud, carries with it a fine of up to $1 million and a prison term of up to 30 years. That's easy to remember because most loans are done for 30 years. So a lot of people went away because of loan fraud. Now, as a result of all that misbehavior, the lenders no longer can order appraisals directly from the appraiser. Now the lenders have to order it through a third-party company. that third-party company is the one who reaches out to the appraiser and says, we need an appraisal for this property by this date. And so that third-party company has to get paid a little bit for connecting the two, but the lender can't have direct access and communication with the appraiser because of all that misbehavior that happened. And then also, dirty appraisers, dirty lenders, dirty closing attorneys, dirty real estate brokers, if all of them got together in a transaction, claimed it was worth this when it was really worth this, they could share in that fake profit. And so that was the need for, and part of the problem of this 2008 crisis was fraudulent behavior like that. So the Dodd-Frank Act was enacted to help fix these problems. And so that meant that the government stepped in and kind of provided some oversight that they previously had not. So that government oversight includes making sure the conventional loans as well as FHA and VA loans are handled properly. So because of that government oversight, as a result of 2008 misbehavior, we can say that RESPA includes all loans, and that they include loans financed with a federally related new loan, and that includes even conventional too, because of the oversight. So what's the lender responsible for? They have to provide a loan estimate showing that borrower, here are all your expenses. No surprises. I'm going to show you now, way before closing, 30, 60 days before closing, what you're going to be paying in the format of this thing called a loan estimate. And it looks like this one on the left. They also have to provide them with this other document called Your Home Loan Toolkit. It's essentially a document that says, make your mortgage payment. If you don't, you could lose your house to foreclosure. Talks about responsibility and priority. And they have to provide these things within 3 days of loan application. When is loan application? Do you remember that from a couple hours ago? What's the official activity or action that constitutes loan application date? What's happening? They're applying for the loan and providing the lender with what? They're applying for the loan. They're giving the lender the what is the thing that makes it, that triggers this 3-day period? There you go. You got it. The property address. What is it that you're borrowing money to buy? That's it. From the date the property address is given, that's the loan application date. And now that lender has 3 days to provide these things. Let me show you something. This RESPA thing, there we go. Is standard. Looks the same for everybody. And it has all the items in the same place within the form, so that if you get a loan estimate from different lenders, it's no mystery. Nothing's hidden. And so in this case, you can kind of see this is the way it's laid out for every lender. The address, the parties in this left-hand side, the type of loan. Is it a 30-year fixed rate, conventional, or FHA or VA? Is there a rate lock? Is it in effect yet? What's the loan amount? How much is going to be borrowed? That's the first thing under this loan term section. And at what interest rate? And then what's your payment going to be? And then is there a prepayment penalty or not? Is there a balloon payment or not? And then the breakdown of your monthly payment. And then they talk about how much the buyer is going to need to bring to closing total. This 8,000 number is how much their closing costs are going to be, but then they're also going to need to include down payment on top of that, So in this case, the borrower is going to bring $16,054 to the closing table in the form of a certified check, by the way. They can't bring it in. We don't want buckets of cash, right? Need to make sure it's proper funds. But that loan estimate looks like this. And there's multiple pages. Second page has more of a breakdown of some things. Here's the closing, one of the pages of the closing disclosure. So the loan estimate looks like this. And then fast forward to the closing where they list out all of the various fees, and it looks sort of like this. And they have got some definitions of what does it mean for appraisal and late fee and refinance, and who's the actual loan officer, loan originator, and then some other things we could talk about later. But the loan estimate pretty much looks like this. And then if we fast forward to the closing disclosure, that's got to be provided within 3 days of the actual closing. And take a look. Oh, look, it says closing disclosure. Wow, it looks exactly like the loan estimate. Here's the loan estimate again. And here's the closing disclosure. It's just the title that's changed. That's how transparent these documents now have to be. And it shows the same stuff. Loan amount, interest rate, payment breakdown, and then more specifics about the actual fees and what ended up being charged. So the closing disclosure that you get and have to sign at closing is a lot more involved than it was back when it was just a loan estimate, because now it's the real final figures, right? And you've got all these things. So we cover this thing in post-licensing 302, this actual type of form. We figure out where do all these things go. And we can already recognize some things, points. If we have any discount points, they would go up here at the top. If you had an origination fee, that would also go in this block. The appraisal fee goes in this block. Any inspections or survey that the buyer chooses to get would go down here in block C. And we talked about paying that homeowner insurance premium for the first year. That goes in its own section called prepaids. And then those escrows collecting like 3 months of taxes, 4 months of insurance, that goes in the part about escrow collection. And then at the very bottom, there's also real estate commission. Let's not forget that. And that shows under the seller column, because this whole page is left side is buyers, right side is sellers column. And then at the bottom of the page are the total expenses to the buyer from this page and the total expenses to the seller. And then those come over to it. You don't have to know this in depth, but they come over to this other page. And it's hard to tell from here, but this is essentially 4 blocks. 1 block for all the seller expenses, which are right down here, lower right. Another block of all the seller credits they're getting credit for, including the sale price. And then the buyer side. What does the buyer need to bring to closing? They need to bring the sale price in the form of their down payment as well as the loan amount, because that loan amount is a credit to them. So in 302, we really kind of get real comfortable with this closing disclosure. But I just wanted to point out how similar they look to each other. Loan estimate compared to closing disclosure. Something else that shows up in the closing disclosure is this section. It compares the quotes and the promises, the estimated amounts back from when it was a loan estimate, and compares it to what it ended up being in the final numbers at closing. So this is important because it shows how good was the lender at predicting what things were going to be, at giving the buyer a good, fair, solid estimate of what those expenses are going to end up being and end up costing them. So with that said, now that you've seen a better version of all of that, let me show you this. Testable question here. We just talked about that loan estimate and this home loan toolkit document must be given to the borrower by the lender within 3 days of the loan application, which is the point at which the borrower gave them the address that they're borrowing money to buy. And then the lender has to give the buyer the closing disclosure within 3 days before the closing day. What happens if they give them a closing disclosure 3 days before closing, and then tomorrow, 2 days before closing, the interest rate changes? If something like that changes, then there's got to be a new 3 days given. So guess what? Right now, what are we on? Tuesday? Right now, let's see, Wednesday, Thursday, Friday. We're set for a Friday closing. That's 3 days in advance. And the lender did their job. They gave the borrower the closing disclosure today. But then let's say Thursday, the interest rate changes for some reason. The lender will have to give the borrower a new closing disclosure. But that's going to require another 3 days for them to have time to look it over and make sure they're comfortable with it. That means we're not closing on Friday. A new 3 days means Friday, Monday, Tuesday. We're closing on Tuesday at that point. So, loan estimate is due to the buyer from the lender within 3 days after loan application. Closing disclosure is due to the buyer from the lender 3 days before the settlement date. So that 3 days is pretty consistent date. That's all according to the requirements under TILA RESPA. Oh boy. This is the best acronym in real estate. It's both of these acronyms combined together. It's actually called TRID, T-R-I-D. Stands for TILA RESPA Information Disclosure Act. So Truth in Lending Act, Real Estate Settlement Procedures Act, Information Disclosure. And it requires all of these things. We come back next week, we'll talk about those different tolerances. That's a little more of a complicated discussion. We'll finish this chapter 11, or maybe it's 12, I think 12. We'll do the closing math, by the way. That includes tax proration, interim interest, various things like that. You can see those things if you want to plan ahead on my Impact Broker Coach YouTube channel. If you scroll to the bottom of the videos, see the oldest ones that has the math, you'll find them down there, where I kind of narrate a walkthrough of my iPad and show you how to calculate these things. So I'd suggest doing that. Here's the other thing. Your midterm exam. We haven't reviewed that yet. So if you haven't taken it yet, here's your chance. Take that midterm exam between now and Monday. Email me your grade. How do you get your grade? You add up the questions you got right and divide it by the total questions on the exam. That's your grade. So email me your grade and then bring me any questions that you saw on there. When you read back through it after you grade it, some of them you'll probably see and you'll be like, oh, well, that was stupid. I should have known that. I get that now. It makes sense now. Other ones you might still just not understand why you got them wrong, and that's okay. So tell me those either between now and Monday, or bring them Monday and say, can you explain number 38? And we'll go through it and spend some time in class, and I'll walk you through those questions and talk you through why the answer is the answer. Guys, I can't express how important those practice tests are. And my time with you in explaining and walking through those is huge. So don't just throw that opportunity away. Bring me your questions for the midterm. Don't be passive. You've got to be proactive in your time here with class. Give me more answers during class, and make sure that you're showing up, because that time is being calculated. And so if you're missing the time required, you could end up not being able to take the final exam. So bring me your midterm questions and be ready for this closing math we'll go over, and I'll see you next week. Have a great weekend.